Okay, good morning, everyone. Welcome to Trading 101. We're all so excited to have you here. This is our second run of Trading 101. And we've had such great feedback from our first round of participants. And we've actually, because people were requesting us to bring it back, that's why we ended up bringing it back. So I'm just going to go over a little bit what you can expect for today, what's on the agenda. We have 2.5 hours scheduled for today, and the first 2 hours are going to be instructional, and then the last half hour should be question and answer if we have time to do question and answer. We have a very detailed example that we're going to be going through at the end to show you kind of everything we're learning today. It's going to come together at the end, and we're going to go through a practical example of how to do it. So we will be taking a break at around the 1 hour mark. We'll take a 5-minute break, and I'll let you all know what time to come back so that you're ready and prepared for that. Oh, yes. So if you haven't joined the Facebook group that's for this course already, please do join it. It's very, very important that you join the Facebook group. We have all the resources for the course are going to be there. So the handout. So if you haven't printed the handout already, make sure that's the first thing you do when you're done. The handout was created to complement the seminar in perfect unison, and it's a great resource to have and a great way to practice your knowledge. And then we'll also be posting some spreadsheets on the Facebook group. We are going to be posting the recording of this video on the Facebook group. And of course, that's where you can expect to ask any questions. And myself and Esma and Stacey, we're going to be as responsive as we can humanly be to your questions. And it's also useful to see the other questions that other people have, and kind of learn together and bounce ideas off each other. So we have 46 participants, 46 people registered for this course. And right now we have around 30 participants right now on this Zoom call. So as you can imagine, it would be very crazy if everyone were to just talk at once and unmute themselves at once. So I'm going to ask you all to just please keep yourself on mute. And if you have any questions, please do use the chat box. We have Stacey, which I think Stacey, your camera's off, but Stacey's around. There she is. So Stacey will be monitoring the chat, and if there's a question that she can answer, she will be answering it for you. And if we need to bring the question up to Esma's attention, Stacey will bring it up for her. If you're getting lost, then just say it in the chat that you need some more time for Esma to explain things, and and Stacey's actively monitoring the chat, and she will take care of that for you.
So just a reminder, sorry, Yasha, if you can put a Q before your question, so that way we just know there's a question that we need to address as well as at the beginning.
Yeah, so that alerts us that you actually have a question and you're not just chit-chatting, and we can pay more attention to it. So let me just introduce our instructor before we get started. Esma is an optometrist. She has been trading since, I think, March 2020. Is that right, Esma? Yeah, around there. And
January.
January 2020. Okay, so you got in before the crash, huh? That's smart. Yeah.
No.
So
No.
So Esma has been trading since 2020, and she's an optometrist, and she works 2 jobs at 2 different locations. One of them is travel. She has to go and travel to a different location outside of where she lives, so that she could go to that job. So she's insanely busy, and even with her full-time her full-time jobs, and she has a family. She has a 3-year-old daughter. A 4-year-old daughter. And even with all that, she has been able to successfully trade and make her way out of $80,000 of debt, and make some money, consistently make money on the side every single month for her trading. And it's allowed her to actually downsize her work hours and reduced her work hours. So it's been an amazing experience for her. Asma has taken so many courses and has invested so much in her education. And she basically thought to develop this seminar, which is a way, which is something that she couldn't find when she started trading. A lot of beginner seminars are either too little information, or they just throw like facts at you and you don't have any practical ideas of how to take it and you know, actually trade with this knowledge. So she worked hard on developing this seminar as a step-by-step guide for everyone, so that they could actually take the information and make use of it. So we're all very excited to have her as our instructor today. And without further ado, I'm just going to let you take over.
Hi guys, good morning. Okay, it says we have how many people? I think it's 29. So there's a good bit of people will be watching the replay, and you'll probably also watch the replay. So guys, remember this is live, and although we've tested our connections and tested our sounds, if something does happen, don't worry, take a break, and and I'll be back. So but the first thing I want to do, guys, is I want to acknowledge all of you West Coast people. It is super early on a Sunday morning for you, and I know that that is not fun. And so I just want to acknowledge that. Like, I understand that I understand this is effort for you to be here right now. So I want to acknowledge that. All right, so I'm going to jump into it. And thank you, Yusra, for the intro, and thank you, Stacy, Stacy's going to be manning our chat today. I'm not going to be, I may take breaks and look at it, but I'm probably not going to see the things in the chat. I'm going to rely on my admins to let me know if I need to be alerted to something. So we are going to jump right into it, guys. This is, we put a lot into coming up with this seminar, and it was really a challenge to put something together that was, actually had knowledge, had concrete information in the 2 hours that we had. And our goal was to make sure that in this 2 hours, you were going to get the information that you need to, be able to turn around next week, tomorrow, and put it into practice. So that was the goal, guys, because again, I've taken a lot of courses. I'm a serial course taker, and I was frustrated with some of the, selection of some of these low cost level options that were out there, where I would take it and I felt like, I didn't really get anything out of it, or, almost like, okay, I could have like watched a YouTube video and learned this. So I wanted to make sure what we put together today was going to be concrete and actionable and step by step. Okay, so that was the goal. So this is going to be an overview of what we're going to do today, right? So I know a lot of you have printed out the handouts so that you can kind of take notes on the handout as you follow along. I just have the slides printed out in front of me. The handouts are somewhere, but we're in intro right now. So the first thing we're going to do is we're going to talk about how to find the stocks, and this is going to be your watch list. Super important. We cannot move on to steps 2, 3, 4 if you don't even know how to figure out what a good company is. So that's where we're going to start. The next step is what I actually think is the most important out of probably everything we do today, is assessing the risk. As a beginner, as somebody who's starting out, you really want to get a hold on risk management, okay? And then we're going to take a break. So we will be roughly at the half point. And then we're going to go into probably the most requested. Everybody asks about, when we took a poll in the group, what would you like to learn? What would you like to know? Most of the responses were technical analysis. So that's probably going to be the popular one. And then we are going to talk about some guidelines to wrap it up, avoid major losses. And then at the end, we're actually going to go through an example, okay? Yusra, Stacy put in an example that we are going to go through from step 1 from entry to exit, okay? And so I actually have not done this example, so I will be doing it live with you guys, right? Heads up, there are going to be some calculations, some simple calculations, some simple formulas. So it would be good if you were able to follow along with some of that, maybe have a simple calculator if you put your phone away. If you don't worry about it, because you can come back to all of this. Okay. Next slide. Okay, so again, intro, it's a pretty slide. We're going to skip it. Oh, I think we skipped a couple slides. Okay. All right, so what are we going to expect from today's presentation? Again, I'm going to show you, I'm going to demonstrate how to choose the stock, and we're going to go through entry, we're going to go through exit, and we're also going to talk about minimizing losses. So the point of all of this, you guys, the point of all of this, I think it's really important as a beginner, is to be focused on minimizing the risk, lowering our risk. Okay, that is super important because that is what's sustainable. Okay, do you see that cute little baby who doesn't have his clothes on, who lost his clothes somewhere, who knows where? So I mean, we don't want to be cute like that baby. We don't want to lose our clothes somewhere along the way. And so a lot of times as a beginner, when you're jumping in with no with no guidance, with no knowledge, your thought is you're trying to find you're trying to find the runners. You want to double your money, you're trying to triple your money. That's a beginner mistake that we do. And really, as a beginner, I took this awesome course that was a game changer for me. And so we had to think in terms of the goal is not to make money, the goal is to not lose money. And when I started to think and trade in those terms, then I was actually making sustainable income and sustainable profit. So that's what I'm going to show you guys. I'm going to show you a very low risk strategy. I want you to minimize your risk as you're starting out, as you're learning the skill. Okay, so everything we do here today is going to be consistent with minimizing our risks, with keeping our risks to a minimum. All right, guys. So what I want you to do, and I think there's a little, there should be like a little paragraph maybe or write up in the handout. But, before we start our journey, I'm a journaler, okay? And so I'm going to ask you, the journaler in me is going to ask you to define your why. Why are you doing this, right? And this, for some people, this might sound silly or this might sound weird, but do yourself a favor and, have a purpose and know what your purpose is. When you have a specific why, when you have a specific purpose, you are more likely to stay on track. When you fall off track, you're more likely to get back on. When you need that perspective, right? So for me, I have a very specific why of why I wanted to do all of this anyway, in the first place. And my specific why is that I wanted to work less. That was why I went into this. I was working a lot once upon a time. And even though it seems like I'm working a lot, I actually work a lot less than I used to. And in order to work less, I needed a way to be able to make some income from another source, right? I had a lot of responsibilities. I had a lot of things that I needed to take care of. So my why was I did not want to work 6 days a week anymore. So that was my big why. It's still my why. I still come back to it all the time when I'm journaling, when we have a hard week. And so, and I'm thankfully, I have a lot of 3-day weekends today. So this is my why. So I would like for you to do yourself a favor and define your why. What is your why? Okay. So this is a graphic that we made for illustration purposes. About the difference between, trading, which is what we're doing here, versus investing, right? And so this is not real. This is just one that we did to be able to illustrate. Okay, I want to show you guys how powerful this could be, the potential that this could be. So let's just say you bought this stock. What is it? Let's call it ABC. You bought ABCD at $50. Okay, and you put $50 in, and let's say a year later, ABCD lands at $75, right? So you did nothing. Okay, you did nothing, and you made $25. Okay, that's not bad. That's actually really good, right? So if that's your thing, if that's what you want to do, great. Now, let's say you noticed that ABC did not have this straight upward trajectory from 50 to 75. You noticed that there was a lot of highs and lows in between that time, and you figured out, well, is it possible to take advantage of that volatility and turn this into a way to make some extra money, to build up that nest egg, to turn it into, maybe like a side income, a remote way of making money? Could I do that? And that's what trading is. So let's just say that instead of keeping your money in there and walking away for a year, you sold ABC every time it hit a low, and you bought ABC every time it hit, no, I said that the opposite. You sold ABC every time it hit a high, and then you rebought it every time you did a low. So let's just say you went through and you did that. What would the potential be there? So we went in and we added all those numbers. And if you did that, the profit would have been, instead of the 25, it would have been 59, right? So that's great. That's quite a big difference. Now, the reality is, nobody is that good that you're going to catch the high and the low every time, and you're going to make 100% of that potential. However, there are days where I felt like I was that good, but the reality is you're probably going to go somewhere halfway or 3/4 of the way. So let's say even if it was $30, $40, that's still pretty good. That's still more money than you would have made had you just put your money, had you just left it in there, using this specific example. So this is the difference, right? And this is why we do this, and this is the point of all this. And again, this is why we need to do this with a strategy and with a method and with some education versus, following your whims, because this could also get you in trouble. All right, next slide. Okay, so, and I talked a little bit about this, but again, my goal here is I want you to really minimize your risk. I want you to focus on being as low risk as possible. This is what I call my bread and butter strategy. It's my back to basics. It's pretty much what I do like mostly every day. And the reality is, guys, going after like alert services that show you these runners or that tell you about potential runners and things like that are, these are not sustainable strategies, right? This is not a sustainable strategy. A sustainable strategy is one where your risk is minimized. That is something that you can repeat. So again, I'm going to keep repeating that the purpose of all of this is to minimize our risk. Okay. And next slide. Okay, so we're going to get into it. So the first thing we want to talk about is building a watch list -- finding good companies. That question comes up a lot. How do you even find the stocks to trade, right? Very valid question. Now, let me tell you guys, 80% of my trading comes from my watch list. The majority of what I do comes from my watch list, right? Yes, I will get ideas, from the group, from other groups. I might watch the news or something and decide to look something up, but the majority of what I do comes from my watch list, right? So when you have a good watch list, you've done a lot of the work already. So, and let me tell you something else. Now, when I was learning, I would, I can remember back to some of those early courses that I would take. And some of the advice was like, put good companies on your watch list. And to me, that would drive me insane because I did not know what a good company is. I didn't know what it means to put a good company on my watch list. It was vague, it was lazy. So for example, like, I know that Apple is a good company. I know that Target is a good company, right? But like, what about, for example, I'm gonna use the same example I used last time, Kura Sushi. So if you don't know Kura Sushi, it's one of those conveyor sushi restaurants, conveyor belt sushi restaurants. One opened up by my house. They make a really awesome spicy tuna on crispy rice. I love it. I crave it all the time. But does that make it a good company? Does having a great product that I love, does having a great service that I love, does that make it a good company, right? So I needed more information on what it means to have to be a good company, okay? So here are some things that make up a good company. These are what you're gonna look for when you put a stock on your watch list. It needs to check off these things that we're about to go through right now. The first thing you want to look at is the price. Okay, look at the price. You want it to be at least $7 or higher. Okay, now stocks that are of a lower price point, okay, like penny stocks, they're not good companies. If they were good companies, they would have bigger hands in them. They would have, the big guys, the big banks and the big investors, and they would not be at this price point. So the price is an indication of whether or not this is a good company for the purposes of being low risk. If you're going for something under than that, you've increased your risk level. Let me tell you guys something. I put $7, and the reason why I put $7, it should probably be higher than that. But for example, if we are in a bear market, some of those stocks that are normally trading at like $12 and $15 that are actually decent swing trades are all of a sudden $8 in a bear market. So I didn't want to take those stocks away from you. So that's why I put $7 or higher. However, if we are in like a bull market, if the market is reaching highs, if we were like how we were in January and February, you can probably do better for yourself than a $7 stock, okay? So Tamar, great question. A $50 stock that is now $7. I'm gonna write it down. And this one, I'm gonna come back to it because I think it does not meet some of the other criteria, okay? I'm gonna write that down. Okay, so the other thing, so yeah, $7 or higher, but ideally, if the higher the price, the lower that your risk is going to be, generally speaking, because the price is an indication of the investors, right? Of the big guys in it, of the big banks, and they're really the ones that are moving the market. We don't really move markets. Yes, there's some exceptions of that, but the big guys are really moving the markets, right? And if they're not in a stock, if they are in a stock, it's not going to be a penny stock. So the other thing that we want to look at as an indication of a good company is liquidity. What does liquidity mean? Liquidity means that it is easy to get in it and it is easy to get out of it, okay? There are a lot of trades going on. There's a lot of hands in it. There are a lot of buyers. There's a lot of sellers. So liquidity is the ability for you to like buy and sell, that you can get out of it quickly and you can get into it quickly. So a highly liquid stock is a low risk stock. A low liquidity stock is a high risk stock. Remember, the purpose of all of this is to minimize our risk, to not lose money. So what are the indication of liquidity? So there's two numbers that you want to look at to determine the liquidity. One of them is something called market capitalization. So market capitalization is, the definition of market cap is the price of the share times the number of shares, all the shares that are available to trade. The price times the number, that is the market cap. You don't have to memorize that definition because the market cap is always going to be easy to find. It's always there. And for our low risk strategy, what is the market cap that we want to look at that is an indication of high liquid? That would be $1 billion or higher. Okay. Sometimes market cap is listed in terms of million, in terms of M. So instead of 1 billion, sometimes we'll see 1,000 M. So we put that in there so it doesn't confuse you. But 1 billion or higher puts it in the like large, mid, and above category. Anything smaller than that is going to be too risky for what I'm showing you guys today. Okay. The second number that you want to look at to determine liquidity is the volume. Now, you might see two volume numbers if you're looking for volume, and we're about to show an example. But if you're looking for volume, you might see two things that say volume. One of them is like average volume, and one of them is like, current volume. I look at the average volume. It's more of an indication of what it is, but ideally there probably should not be a huge difference between those two numbers, right? So the volume that we're looking at is 900,000 or more. Okay. If the volume is less, again, it's too risky. The liquidity has dropped. Okay. Now, this is one that people have a tendency to ignore the importance of volume and to forget the importance of volume. And so I want to make sure you don't forget the importance of volume. And I want to give you an example, an embarrassing example, because I know better and it didn't happen long ago. But guys, so I was following, this is a few months ago, actually. I followed an alert service. I'm in a whole bunch of alerts, too many, and really for research purposes because of my role in the group. But anyway, I followed an alert. I blindly bought a stock based on an alert that I got. I didn't check it. Big mistake. And the reason why I did it is because the last time I followed an alert from this group, I made some money on it. So I'm like, okay, I trust them. And so immediately once I bought it, and it was actually not a stock, it was an option, but all of this applies as well. Immediately when I bought it, the price like dropped down. Like I think I put 400 in it, and it went from like 400 to like 300, like right away. And I'm like, okay, that was weird. And then the next day when it opened up, it was up to like 550. So I'm like, okay, I want to take my profit. Like, that's good. I'm happy with that. That's a nice return. So I put an order to sell it. The order would not fill. The order, like an hour later, the order is like not filled. And I'm like, and I put the order to match the price that it was at. It's not like I went above. And then I was like, okay, I'm going to lower it. I lowered it. The order would not fill. I lowered it. The order would not fill. And I'm like, okay, I got frustrated. The day closed. The next day, it opened up lower than the price that I bought it. So instead of 400, it was now like 300. So I had minus 100. And then I'm like, you know what? I want to get out of it at a break-even price. It was fluctuating. So I put a break-even price. Later on in the day, it did reach a break-even price, but my order never filled. And I'm like, oh my God, what's going on? So what did I even buy? I have no clue what I bought. So I went to go check the stock. I opened up the stock profile and I saw that this stock had no volume. It was very low volume, right? So that is why my order was not filling. I could not get out of it. Although it looked like I had made money, although it looked like it was in the green, it didn't matter. There was no buyer on the other side for me to get out of it, right? So it's embarrassing because I know not to do stuff like that. But I'm telling you this story so that you don't forget the importance of volume. Now you can associate this with volume. All right, so next slide. So over here, we have some examples on where you can find the things that I just talked about. Your app that you use, like I use the Yahoo Finance app. I also will reference CNBC website. I use a few brokers. I have Play accounts and I have my main broker. So these are examples of where you can find these things on some of the more popular platforms. Okay, guys, it's all circled, highlighted, whatever. shout out to Yusra for doing this, for including these snapshots that are like labeled. Because if it was just me, I probably would not have done that. I would not have added this stuff. So thank you, Yusra, for demonstrating that. All right. So let me know, is the volume okay? If somebody can tell me if my volume, I'm sorry, is my volume, is my sound okay? Okay, thank you. Thank you. It's a new mic that I just, bought yesterday. So the next thing we're going to look at, we're still on watch list, right? So we've checked off price, we've checked off volume, we've checked off market cap. The next thing we want to look at, I'm actually going to skip the average true range. I'm going to go down a little bit and I'll come back to average true range. What I want you to look at is I want you to look at the annual trend. Okay, so what does that mean? Open up a 1-year chart. Okay, you can do that on any app, any broker, right? So let's just say Apple, you choose Apple and you open up 1 year. Okay. The annual trend should be going up. What does that mean? It should be on an uptrend. What does that mean? It means the price that it is today, should be generally higher than the price that it was 1 year ago, okay? If that's not the case, if the price today is not higher than what it was 1 year ago, that is usually an indication of some type of serious problem that the company is having. Either a financial issue, talk of, I don't know, bankruptcy, defaulting on loan, maybe a major scandal that happened in the news. I had to take off I had to take off Ride from my watch list, Lordstown Motors, an Ohio-based, electric vehicle company. There was a story published about them by a hedge fund, calling Ride a fraud. They said this company doesn't have any real product, doesn't have any real order. Whether or not that's true, that is a serious allegation. So as a result of that, Ride it hit 52-week lows and kept going. So something like that is very risky. You don't want to get into it. I recently got in trouble because I bought a company that was on my watch list. I did not check the year trend. And this company was in trouble. It was actually Just Energy, and I bought it because I already knew the other stuff checked off because it was on my watch list, but things have changed. It kept going. It was a falling knife, right? If the annual trend is down, you're probably catching a falling knife. It kept going down and down. And then I realized my mistake when I went to go check, like, why was Just Energy kept dropping. I looked at it and I saw that the annual trend, it was like a straight down. So I was mad at myself because I know better. That would have been an easy thing for me to check and save me from getting into that trade. In the end, that company ended up getting delisted. They had whatever issues. Okay, so please don't forget to check the annual trend, right? Before you put it on your watch list. And if there's a sharp downward movement, you might want to, before you buy it, you might want to also just make sure that it's not going straight down. I'm coming back to average true range, by the way. So this is a way that we analyze risk, okay? And I know that some people might want to think like, well, if something is on a 52-week low, doesn't that mean it's actually a great time to buy it? It could be a good opportunity, or it could be the opposite. And because I'm teaching you because I'm trying to demonstrate a low risk strategy, it's just too risky. The risk is too great. Find something else. The other thing that we want to look at is this one is heartbreaking. It's heartbreaking for me. I feel like a buzzkill, but we need to have at least 3 months of data. We need to have at least 3 months of a chart, 3 months of trading information, of 3 months of movement to look at. What does that mean? It means those IPOs, those newly publicly traded company, and I hate to say this, but they are very high risk. There's a lot of excitement that that is associated with like a new company, a company that you love, a company that you have a relationship. When it goes public, it's so exciting. You want to be part of it, right? The reality is IPOs are very high risk, especially the ones with, especially the ones that have a lot of PR. You just don't know. And, I can tell you from my personal experience, when I've broken my rule and jumped on an IPO because I really wanted to be part of this company, there was only one time that I've actually made money doing that. And that was a firm. The majority of the time where I did FOMO and jump on, the first day or the first week of a new company, it did not end well. I either would cut my losses, I would get stopped out, or it would turn into a bag, right? So, and I'm talking like even the good companies, I'm talking Airbnb, I'm talking about Coinbase was the recent one, right? The Honest Company, it's just high risk. You guys, there's a lot of companies that 3 months down the line, 6 months down the line are trading at like half the price or lower of the price that they came out at, right? So, I mean, Poshmark is an example of that. It's on my watch list, and I think it's a fraction of the price of when it came out. So, you want to wait 3 months, okay? And now, if you have the opportunity to buy a company before the public has access to it, you probably should. This is not the same thing, right? You probably should. If you were like an Airbnb superhost and you got to buy Airbnb, or if you were a Poshmark ambassador seller and you got to buy Posh, that's different. That's not what I'm talking about here. I'm talking about from the time it came accessible to the public, you want to wait 3 months to jump into it in order to keep your risk to a minimum, right? Okay, so I'm going to come back now to above the slide to average true range. Everything I talked about now, okay, all stuff, the price, the liquidity, the annual trend, waiting 3 months, all of that has to do with risk, has to do with risk minimization, evaluating that a company is a good company and minimizing a risk. Now, this next one that we're going to look at is actually not so much to do with risk. This one is about determining how good it is for trading. Okay, well, like I found these great companies. I have a list of great companies, but does it move enough for me to actually want to trade it? Is it worth my time, right? And that's kind of the difference. Average true range is something you want to look at. This is gonna kind of set apart, the long-term hold versus the one that you want to trade, the one that you want to hold for days or weeks or whatever. So you want to look at the range, the daily range, okay? So what is the daily range of a stock? The daily range is the difference between the daily low, okay, and the difference between the daily high is the true range, right? So the lowest point of the day and the highest point of the day, that is called the true range, right? So we want this number, we want the movement, we want the difference between high and low. In order for it to be worth it for us, we want it to be at least $1. It's got to move at least $1 or 10%, okay? 10% is actually a really big movement. But for example, that $8 stock, like if it moves 80 cents a day, that's not $1 a day, but that's still a big enough movement that, it would be worth it for you to have something like that on your watch list. So now you can check on your broker, on your app. It will tell you the day before, it'll tell you what the daily low and the daily high of the previous day. So when you look up the stock, you can see daily low, daily high. Sometimes I just go with that. I'll look, I'm like, okay, it looks like it moves at least $1. It's moving $4, whatever. Now, to be like more precise and more accurate, especially when there's a lot of crazy movements and you think that day's movement was not an indication of the actual movement, you want to find out what's called the average true range, okay? The average true range is the average of all the daily ranges in a certain time period. So I hope I didn't lose anyone here. Okay, for example, if a stock had a daily range of $2 yesterday, it hit the low, the high to $2, but the day before the daily range was $1, you know, the average true range of that time period is $1.50. So the average true range is a more accurate number to go with versus just what it did yesterday, right? Average true range is it's important because, like I said, this will, you know, this is where we're gonna like make the money, right? We're gonna not lose money, and now we want to make the money, so we want a good average true range. Honestly, this is probably maybe one of the only indicators that I'm even going to talk about today. And the other thing I want to show you is when I learned this, I had a really hard time figuring out where the average true range was. Like, it was not a simple Google search. Like, I struggled with figuring it out. So it wasn't until I was on like a coaching call with some of my colleagues that somebody demonstrated it to us. And I was like, oh, thank you. Now I know. Because I had a hard time finding it, we're going to demonstrate where you find average true range here. Okay. So, and I think we have, okay. So what I like to use is tradingview.com. TradingView is a free site and a free app. It's like a charting site, a charting app. They do have a paid version, you know, where you can do more sophisticated stuff like setting up a screener. I have found that like everything I need is I can find it on the free sites. I have not paid. So anyway, and you can find average. This is the best way that I have found to find average true range is to go to TradingView. So Yusra has put Apple. So she put Apple and she opened up this chart. So you click on chart. And she already has Apple up because she was probably looking at Apple last. So it just showed her when she had up. So if you look at the top bar, you know, there's indicator financial. You're going to click on indicators. So average true range is an indicator. So you click on indicators right there in the middle. And when you click on indicator, you'll have a drop down menu, and the one that you want to be at is called built in. And then when you, when I click on it, it automatically gives me built in. But anyway, built in, and then under built in is going to be average true range. Okay. So click on indicator, built in, average true range. So she clicked on average true range. So what it showed here, once she clicked on it, is it showed this line graph under the candlestick. There's a line graph, and that is a representation of the daily range. But what we want to do is it also calculated the average true range. And we're looking at 1 year here, I believe, correct? This is at 1 year, Yusra? I think this is 1 year. So we want to look at 1 year. So it calculated that the average true range is, oh my God, that's so small, I cannot read it. $33.
It says $33.34.
Okay.
So we had some confusion last time. When you move the mouse, it changes that number. Yeah. Do you see the number I circled? Yeah. Mm-hmm. So it's showing you the day. So the average true range for this day was 42.82. And then when you go, so what you want to do is you want to put your mouse on the most recent day, and it'll show you the average true range over the past 14 days. So as you can see, I know it's a little bit small, but that number in the corner that I circled keeps changing. So you want to hover your mouse over to the most recent day.
Most current price. Okay. So yeah. So does that meet our $1 requirement? Absolutely. So this, so whatever we're looking at now, this is Tesla, right? Is this Tesla, Yusra? I thought it was Apple.
Sorry, I muted myself. Yes, it is Tesla. I changed it to Tesla.
Okay. Yeah, so this is Tesla. So the average true range of Tesla is $33. And so yes, that meets our requirement. So now we demonstrated to you where to find average true range, okay? Okay. And then also there are, we did it live, but they're in the presentation. We do have screenshots of this as well. When you rewatch the recording, well, you'll see this, but you'll also see a screenshot. Okay, so the other thing that we're going to do with our watch list, we're still on choosing our watch list. We're still on choosing the good companies, right? In order to minimize our risk, we want to diversify the watch list. Now, this one is kind of obvious, okay? I think anyone with maybe trading or investing experience knows that you should be diversified as a way to minimize your risk, okay? Diversify your sector, right? So sector would be like travel. Diversify your industry. Industry will be like airlines, hotels. And the reason why that you want to be diversified is because these things tend to move together, right? So like, you know, airlines, they tend to, like, unless there's some kind of something in the news or earnings, they tend to move in the same direction. So when they're up, they're all up. When they're down, they're all down. So it's risky for you to not be diversified, because when it's down, it's everything down. Not only that, but it's actually no fun when your watch list is all, it's risky for your portfolio to be all in one one sector or one industry. Now, in terms of your watch list, it's just not good for trading when everything is going in the same direction, right? Ideally, you want things that are red, lots of red and lots of green. If everything is green in your watch list, and you're like, well, what am I going to buy? It's all high. If everything is red, then it'll be like, well, I can't buy everything. So for your watch list, you want to make sure that you're representing, 3 to 5 sectors, 2 to 3 industries. The other one that is actually not so obvious, but is important, especially like in 2020, it was very important. And these days, is to have geographical diversification, diversifying the country. So I think most of the people that registered this time around are either American or Canadian. I think last time we had some people that were in different countries. But in our markets, right, we have access. We have companies that we can trade on our markets that are not American. They're from other countries. You know, we have lots of Asian stocks. There's European. There's African. So and those are actually good to include in your watch list. The reason why is because when that country is having some type of issue, when they've announced, for example, that they're not able to control their COVID cases or something with their economy or with their politics, their stocks are going to be at a deal. So I do encourage you to have some geographical diversification, because you're going to want to pick those up at that time. Last time I used the example of, find the Teslas of the world. Okay, I'm not going to say that now because I don't feel the same way about Tesla. But I would say, like, find the Amazons of the rest of the world. What are the Amazons of the rest of the world? What are like the Apples of the rest of the world? So, the ones that are the big companies of the rest of the world, I would figure out what they are and put some of those on my watch list. Okay, and then another thing that I encourage you to do as a low risk strategy is it's okay to have favorites, like unlike your children, unlike your kids, it is okay to have favorites from your watch list. In fact, it's actually a good thing to trade the same stocks over and over. I remember being on a clubhouse recently with a group of traders, and one of the more experienced traders was saying that he only trades 3 stocks over and over. And that's actually a good strategy. You become intuitive, you become familiar with their movements, and your favorites are not always going to be your favorite, right? So when we did this last time, space was one of my favorites. I was very familiar with it. I was trading it on I was in and out all the time. I made a good bit of money swinging it. Space is no longer the same stock. So an example of one of my favorites today would be Spirit Airlines is still a favorite of mine. I'm very familiar with the movements. I know when it's a good price. I've been trading Fubo a lot lately, so I'm familiar. I know that when it hits under 17, like it's a buy. So I encourage you to get really familiar with a handful of stocks, right? It makes your trading more efficient, less time consuming, and it is, again, it is a low risk strategy to be really familiar with a handful of stocks. And, you know, a good guideline is you don't want to have too many stocks on your watch list because it kind of defeats the purpose. It's going to be overwhelming. You're not going to know where to start. But then you don't want to have too little where you don't have options. So 30 to 50 is kind of a good guideline. I would say I probably am still in that range. I'll take some out and I'll add some. So I go through. Okay, so assessing risk. Okay, so this part, in my opinion, is really important. So we're going to talk about risk now. So now we have our watch list. Okay, we did our due diligence. We have this perfectly created, curated watch list, right? We checked off. We know that we have good companies that we're going to trade with. So now we're going to assess whenever we want to enter a trade. Before we do that, we want to assess the risk. Of like where it is today, for example, where it is when I want to enter the trade. Okay, so these are general guidelines. These are not as set in stone as the watch list stuff that we talked about. You know, that stuff I don't want you to stray away from for the purpose of minimizing your risk. So these are general guidelines that I would just want you to keep in mind. Obviously, don't trade with more money than you're willing to lose. Although we are minimizing our risk, right? There are no guarantees in the stock market, right? We are going to put all the odds in our favor that we can, but there are no guarantees. So, you know, don't put more money. This one is obvious. Don't put more than 10% of your capital in one stock. Here's the thing. For me, that applies today where my portfolio is. If you have a smaller portfolio that you're trading with, if you have less capital, you know, that 10% might not be very substantial. So your number might be more like 30%, 50% if you have a small portfolio, you know, that's okay. You know, the larger the portfolio is, the less you want to put into one stock. Another thing is, you know, check the news. So check a headline just to make sure there's no major scandal happening. I don't want to get into a company that's having really bad PR because it's, you know, it could turn into a falling knife. So if I see really bad PR, I'm going to wait. I'm going to wait and see what happens. So just check the news headlines, make sure their CEO is not, you know, getting accused of like money laundering or something like that. And then, so this one is important. Do not hold through earnings, right? So publicly traded companies are required to report their earnings every quarter. Every 3 months, they are required to report to investors their earnings. Now, here's the thing, is there is oftentimes a dramatic response to earnings, okay? And there's no rhyme or reason. I like to identify patterns. I have not identified any pattern with earnings. The same company will report the same type of earning. One quarter, it'll rally. The next quarter, it dropped like 10%. Like there's no pattern with earnings. The reality is it is very high risk to hold something through earnings. So if I'm about to enter a trade, I'm going to check the earnings dates. And if they're reporting earnings today, tomorrow, I'm going to stay away. With that said, post earnings can create great buying opportunities. However, you don't want to buy too soon. You don't want to buy it the day, you know, the day that it reported or the next day even. I think the next day is too soon. It's just too risky. Remember, we're minimizing our risk. So when you're buying too close to post earnings, it is risky. So I would say wait 2 days, all right? And I was actually trained to wait like more than that, but I would say wait 2 days. I feel like I'm good with my risk if I wait 2 days after earnings.
Hey, Asma, can I ask a quick question? Okay, or kind of clarify. So Tamar, that's a really good question, right? So I think for us, all of us have sort of different strategies as to how we like invest in stocks, right? So myself, I have a swing trade account, and then I have one that's long-term that pays out dividends. So Tamar's question is, what happens if you have a stock that pays dividends? Does that go into your long-term list and hold through earnings to get your dividends, right? And so for those that are looking for long-term investments, that is something that you potentially would want to do, is just keep on your stocks in your long-term list, right? But for the purpose of swing trading, which is holding it for a couple of days, sometimes day trading, most of us really do swing. What you typically would try to stay with these general guidelines to minimize your risk. So essentially, if there's earnings and there's dividends that's paid out, we typically know that well, anytime a dividend gets paid out, by the way, by the nature of paying out the dividend, the stock always goes down the following day. It's just the way that that the market works. And so when you're doing swing trade, you kind of are aware of that and make sure that you take advantage. And as Esma says, sometimes it could go to the low as soon as the next day, or it could go to the low as in like 2 or 3 days. Like, for example, Cody, really good example for me. I was too busy and I didn't follow I didn't follow my method. And so I jumped in too early after earnings. And of course, what happens, it dropped even more. And so my entry, and we all will make mistakes, by the way, right? Like, we're not going to get it right 100% of the time. By nature of, because there's a lot of steps that there's steps that you sort of have to do to kind of analyze it and make a decision, right? Esma is really good about looking at stuff and saying, no, wait, don't do it yet. Like, I think there's a little bit more. Whereas like during the day, I'm working like the whole entire day. And so I look at it and I just make like a judgment call, right? So just kind of be careful about what you're doing there. But I do have long-term dividend stocks, Tamar, in a totally different account. And I don't typically touch those unless I know there's going to be a big dip. I potentially may sell a portion of it, and then I would take my earnings and then rebuy it when it dips. So that's how I kind of trade my long-term. Sorry, Esma.
So, and then I also wanted, I'm reading some of the questions now in the chat, and somebody asked about Excel. What about a company that, was a $50 stock and then now it's like $6 or $7? Well, so going through our watch list standard, right? Our high standards for keeping our risk low. I was looking at Excel now. Excel does not meet our, Excel is on a downtrend, meaning that it's lower today. First of all, hasn't even been, because this is a newer one. Let me see. Yeah, it has been.
Sorry, Esma, I'm going to interrupt you just because of the interest of time. If we could get through the presentation and hold questions until the end.
Got it.
All right.
So thank you for keeping me on top of time. But yeah, Excel does not meet, it's on a downtrend. So that is not one that we would put on our watch list. That would be high risk. We would wait for it. Okay. And so this is, this one I think is obvious, so I'm not going to spend time. This is one that we added to the presentation since last time, just because honestly, this has become such an issue. The YouTuber influencers, the alert services, the meme stocks, all of these, as exciting as they are, as fun as they are to watch, they are very, very high risk, really high risk. So I'm going to ask you to stay away from those, right? Stay away from those. And also, I want to tell you something right now, and you're not going to believe me, but I'm telling it to you with conviction. Your own curated watch list and your own method and your own strategy that you stick to and that you're consistent with is better than any of those alert services out there, okay? You are going to be better, okay? And I'm telling you that with conviction. I don't care if they're if the person who's in charge of the alert service or the person who's done it, I don't care how successful they are, how much money they have, they're successful and very profitable, not because they're following an alert service or they're following somebody else's alert. they're successful because they have their strategy and their method that they're doing. So your own strategy, your own curated watch list is going to be better than any of these alert services, okay? All right, so we can move on. Okay, guys, so I really want to get your attention here. You know, I know as an optometrist, I have to do these CE requirements, and I know there's actually a few optometrists with us today. And for me, like if I have to sit down for 2 hours in any CE, you know, I am dozing off. Like there's no way I'm paying attention for 2 hours. So with that said, if I had to choose the most important slide, if somebody asked me, if I had to pick, if someone asked me what is the most important slide out of everything we're doing today, I would say it's this one right here. It's the ABC formula. So I'm saying that because I want to make sure that for this one, I have your attention. Okay, for this one, you're awake. So this is the ABC formula is how we are going to determine whether or not this stock is good to buy right now. So we already know, now we're looking at good companies because we already vetted them and we put them on our watch list, right? But when is it good to buy? At what point is it to buy, right? So this is the ABC formula is a way that we are going to calculate reward to risk ratio. Now, you guys, in my experience, in my education, in my background, you know, I was exposed to a lot of different methods for calculating reward to risk. I like this one the most because it doesn't involve any charting, any drawing lines. To me, it makes the most sense. This is one, Terry teaches something very close to this, Terry Igioma in the class that I took. This is what I pretty much do almost every single day, okay? And honestly, somebody posted in our group an article, a Kramer article. Not that I'm the biggest fan of Kramer, but I find him entertaining. So he had an article where he said, what we want to do is we want to find beaten down stocks of good companies. I actually agree with that. Now, if we were going to put that into a formula, if we were going to quantify what it means to be a beaten down stock of a good company, I would say it's this formula right here. Okay, so I've got your, so what we want to do is we want to open up we want to take a stock that we're looking at. Let's just say we're looking at, what is the example that we use here? Square. Okay. Let's say we're looking at Square. We opened up a time period, 1 month. So 90% of the time that I apply this formula, I'm looking at a 1 month chart. I'm opening up a 1 month chart. So let's say we're looking at 1 month. We want to find what the high point of the month is. Okay. What is the highest that Apple reached or Square reached for that month? Okay. That is going to be A. And now we're going to determine what the lowest of the month is. That is going to be C. I skipped one. And then what it is either right now or the entry price is going to be B. But for the purpose, I think, of calculator, we're going to do what is it right now. So A, B, C, again, the high of the month, where it is right now, and the low of the month. These are the 3 factors that we're going to use when calculating reward to risk. Okay. So the reward, excuse me, the reward is going to be the difference between the highest of the month and where it is today. Okay, that difference is the reward, A minus B. The risk on the other side of it is going to be where it is today, the B, minus where the lowest of the month was, the C. So that number is so we're going to take reward, we're going to take risk, and we're going to come up with a ratio. Okay. Reward over risk. And so what is a good ratio? Now we have a ratio, but what is a good ratio that we want to look for? And this slide kind of answers the question, you know, if you get a 1, is that good? No, please don't go for a 1. If you get a reward to risk ratio of 2, is that good? Honestly, you can do a lot better for yourself. You deserve better than a reward to risk ratio of 2. I think you could do much better than that. So the number that I think is solid for a reward to risk ratio is if that number is 3 or above. then I think we're solid. I think we're getting a good deal, right? We're getting a good deal. Now, again, we've already checked off all that other stuff, right? So we know that it's not on a downward trend for the year, and we know that there's liquidity and the price, and we know that there's volume and all of that. I'm repeating myself here, but I want to make sure, like, we've already done the part of determining it was a good company. Now we want to figure out the price, and we're going to use this one. Now, I will sometimes, if something is highly liquid, I may go for like a 2.5, 2. But you know, the lower that reward to risk ratio, the greater our risk is. And you know, I'm trying to show you how to minimize your risk, how to not lose money. But if it's Amazon, if I'm talking about Amazon, something highly liquid, I might go for a 2 or a 2.5 with Amazon. So like I said, 90% of the time I'm doing this on a 1-month chart. However, you know, there are times when I would prefer to open up a 3-month chart to calculate this. Those times are when, for example, there's a lot of volatility on the 1 month. I may look at a 3 month to kind of even things out. Or if I'm looking for a longer hold. So for me, most of what I do, I want to hold it days to weeks. So it makes sense. So that's why I look at a 1-month chart. But if I'm looking for longer holds, a 3-month would actually be it would be practical. It would make sense. Now, if I'm looking for a day trade, and I'm not a day trader, but if I'm looking for a day trade, then I might actually look at the 1-week chart and compare where it is now, compare it to the high and the low of the week. But 90% of the time I'm looking at a 1-month chart. So we're going to go through an example, okay? Because again, this is, in my opinion, this is the most important thing, is to be comfortable with the ABC formula, okay? So
I'm sorry, Asma, I'm just going to interrupt you. I want to point out that the current price you see on the slide is a bit different than the screenshot. That's because the screenshot doesn't show the movement that happened after market hours in the aftermarket hours. So that's why the current price is a bit different. I meant to change this and I forgot. But just take it on trust that the price right now is $209.25 per square.
Okay. Yeah. So, okay. Thank you for pointing that out, because I was looking at it like, wait, that's not the price. Okay. So, Yusra used the aftermarket price, but when she took the snapshot, it showed what the price was at the when the market closed. That's the $2 difference. Anyway, here's the thing, guys. Whenever we're calculating the ABC, when we're coming up with our reward to risk formula, there's actually nothing that says monthly high, monthly low. That's not listed the same way that like volume is listed or daily high, daily low. So how I figure that out is I open up a line chart and I'm simply just on my phone or using the mouse, my cursor. I'm simply like using my finger, I'm using the cursor to manually find the high point of the month. And I'm using my finger to manually find the low point of the month. There's no other way that I have found, at least. So that's how we're going to do it. So this is Yahoo, right? This looks like Yahoo Finance, that a snapshot, or is this CNBC? It looks like Yahoo to me. Okay, so we have Square. Yeah, it says on here Yahoo Finance. So we have Square. And we've already vetted Square. It's watch list worthy. And we opened up the 1 month, okay, and we figured out that the high of the month for Square, the A, so the high of the month is A, is 263.08, and we just did that manually, okay, following the line graph. And the current price that we're going with is 209.25. And the low of the month, again, we figured it out manually, is 197.13. So that's our C. So we're going to plug in those numbers to get a reward to risk ratio. And then you guys can kind of calculate along, but A minus B is 53.83, B minus C 12. I'm looking at these numbers and I'm like already excited, like 50 something, and then it's 12. Like I'm already like, oh, this is going to be good. So the reward to risk ratio is over 4.44. So that's pretty good. That is a pretty good reward to risk ratio right there. This is one that I am interested in taking, okay? And we can go to to answer the next question. So the next thing that we want to show is I've determined that it's a good reward to risk ratio. So how many shares though should I buy? Like, should I buy like, you know, what percent of my portfolio would be appropriate to buy? Obviously, when something is a higher reward to risk ratio, it would make more sense to think that you want to buy more of it, you know, versus when we're at a lower reward to risk ratio. And so here's one guideline. We're going to build off the ABC formula, and we're going to call this the BCD formula of how many shares to buy. Okay. And so we're using the same B, which is the entry point, and we're using the same C, which is the lowest of the month. Okay. And so remember that B minus C is the risk. So we're looking at the risk to determine. So when we're trying to figure out how many shares to buy, the risk matters, the reward doesn't matter as much. And we're going to add D. So D is basically what you're willing to lose on a trade. Okay. This can be a percentage of your portfolio. Like for me, like, okay, like I don't want to lose more than, you know, 1% of my whole portfolio on a trade. Okay. Another, one of the books that I like, they said that number should always be 0.75%, like Swing Trading for Dummies. So anyway, this number is going to change for you. Everybody is going to have the same B and C when we're doing the same example. The D is going to be different for you. It might be like, let's just say for simplicity's sake, you're willing to lose $100 on a trade. So we're going to plug in $100 over the risk, over the B minus C. And so what do we get here? We get 8.25. So if we are willing to lose $100 on a trade, based on where Square is today, we would buy 8 shares of Square, right? And this is, again, to minimize our risk. We're doing this to minimize our risk. So that ends up being 1577.04 of Square. Now, for some people, that might be still too high because of where their portfolio, with the capital that they're trading with. You know, if I only have, you know, if my capital is like 2,000 or something, I might not want to put so much into one company. For me, I would feel comfortable buying that many Square. I would probably even buy a little bit more Square. But so this is, so the ABC rule, I want you to really not stray from that. It's very important. The BCD formula it's a really good guideline, but again, it also, your portfolio size is also going to matter here, right? Now, these calculations, guys, if any of it just like went above your head, don't worry. Like, you have this recording, you're going to be able to come back to it. You have worksheets, we have some practice on it. So don't stress out if you're like, oh my God, this is confusing. I promise that it's simple. I promise that it's simple. You just might need to watch it again, or you just might need to go over it again. So don't let this stress you out. You know, we intentionally kept things very simple here. Okay. So
I'm just going to interrupt you, Asma. I think it's a good time to take a little break and then come back, because the next slides are related to technical analysis and they're a little bit dense. To add on to what Esma said, we do have practice questions on your handout to help you with these two formulas. And a couple of our participants last time actually created spreadsheets so that Excel calculates this stuff for you, and you just input the values. So we're going to be sharing that on the Facebook group as well. So please don't stress out about this. So we're going to go ahead and take a 5-minute break right now. So if everyone could come back in 5 minutes. I'm on the West Coast, so that's 8:20. I'll be back at 8:20. I think in Texas, that's 10:20. Yes? All right, so we'll take a 5-minute break, and I'll stop the recording now, and we'll see you guys in 5 minutes. Okay, welcome back, everyone. So before we continue with the presentation, I just want to ask Asma a couple of questions. First of all, in terms of biotech, that has an unusual peak with FDA trials. do you, how do you analyze that for your formula?
Okay, good question. I'm glad you brought up biotech. Here's the thing with biotech. Does it meet all of the does it meet all of what we talked about with the watch list criteria? Because, you know, a lot of, you know, viral penny stocks, $10 or less, $7 or less stocks are in the biotech category. So what you're talking about, first of all, make sure that it actually meets the criteria. And you're right, there is going to be like unusual peaks. They are very volatile. Now, one thing to know though is the biotech, I guess, like pharma, the ones that are high liquid, higher price points, you're really not going to see a lot of crazy peaks in those. The ones where you do see these peaks, my experience has been the ones that are high risk anyway. So so that's what I wanted to say off the top. The biotech that you're looking at, does it check off all of this stuff?
Yeah, they're usually very low liquidity. So they either have a small market cap or low volume trading. So again, we're starting with the watch list first.
Right.
That's step one. And then we get into the formulas and the technical analysis. Okay, right. Then I have the second question that I thought it's very important we go through this.
Sorry, Wisha, to cut you off. With that said, if the ABC formula does not make sense to apply to something that does not meet our criteria, it's going to be all over the place. So the ABC formula really works really, really well when we're using it for the checklist, when we're using it for our perfectly created watch list. This, if you're applying it to like a low volume or a penny stock, it's not going to make sense. It's not going to serve its purpose.
Okay, so the second question that I think a lot of people are in this situation. You have right now a lot of people who have already started trading and they have a lot of stocks already in their portfolio. So the question comes in, if we do this risk to reward ratio formula and the BCD calculations on stocks that we own currently, should we get rid of them and move that capital?
Okay, awesome question. Okay, my answer to that, if you're already holding these positions and you realize now they don't meet the, you know, the R&R or whatever, I would not get rid of them just because of that. You know, like moving forward, we're going to apply this to make sure we're minimizing our risk. But if you already have it in your position, if you already have it, I would not get rid of it just because of that, right? I would not take a loss just because of that. You know, if you want to cut your losses for other reasons, you need the money, it's not moving, that's fine. But just because it doesn't apply now, I would not cut my losses.
And you know, you do have resources on the private Facebook group. So if you want us to go through what your positions are and just kind of look at, you know, maybe offer like some ideas on what you should be looking at to decide whether to cut something or not cut something, we could definitely do that on the Facebook group. So with that said, we're going to get on to everyone's favorite subject, which is technical analysis.
Yes. Okay, I actually want to say, because I'm not sure if I answered Tamar's question all the way about the peak. Now, let's just say the company you're looking at does meet the criteria. The other thing to know is that when it's peaking like that, it may go under the category of like, you know, like a YouTube stock or a meme stock or a penny stock. So it might be, you know, if it's talked about a lot by these influencers, it may also go under that category. Those stocks, those hype stocks do a lot of this thing over here. So I would, you know, use your judgment to determine whether or not this is a, you know, a YouTuber stock, an influencer stock, and just know that you're taking a risk. So I hope I answered your question by giving you, I hope that answers, or that gives you some kind of guidance. Okay, so technical analysis, guys. So I'm going to start off by saying this was a challenge for us, okay? A challenge for me, a challenge for us. The reason why is because when we took a poll, before we put this together, we took a poll, we asked our members, what do you want to learn about? What do you want to know about, right? If you were going to pay us money to sit here with you and make it valuable and make it worth your time. And the most common answer that we got, from what I remember, was technical analysis, was chart reading. Here's the truth. The truth is, you know, I took a 4-week course, a wonderful course. Really, that 4 weeks, it was more like 8-12 weeks for me. It took me a while to get through it. And in that course is where I learned technical analysis, is where I learned to chart and where I learned to find formations. So it is a challenge to be, with the time that we have, it is a challenge to put something together that is actually useful and practical, right? We're not going to be technical analysis pros or anything. My goal was to show you something to where you are going to be able to apply it and use it, and maybe use it as a foundation to build off of. So this is what we came up with here, okay?
So actually, before we get into this, you guys are going to be the first ones to hear about this. But Asla, did you want to announce what's happening next month?
Oh, yay, I get the privilege of announcing. I actually was going to do that at the end of this. Because
okay. I'm sorry.
Marks. So I was going to address the question marks.
Jump the gun there.
Like last time, remember there were so many questions at the end of the section. So thanks though for reminding me. Okay, so the first thing we're going to do, guys, is, oh, by the way, everything that we learned in part 1, okay? The curating the watch list, making our perfect watch list, analyzing risk, those formulas, how many stocks to buy, all we could determine, we could come up with using a line graph, using a simple line graph that you can pull up on Robinhood if that's what you want, you know, on your app, okay? So now from here on out, we are going to switch to a candlestick chart, okay? We need candlestick chart for what we're doing next. And so the first thing we're going to do is an anatomy of a candle. For some of you, this might be basic, but if it's not basic, we absolutely have to go over it. So if this is repetitive, just be patient. The anatomy of a candlestick, right? So we have the body of the candle, we have the wick at the top, we have the wick at the bottom. Now a candlestick represents a time frame. So when I'm evaluating a chart, most of the times I have it set to 5-minute candlesticks. When I'm looking for gaps, by the way, I have it set for 15 minutes. Gaps show up on the 15 minutes better. By the way, we're not talking about gaps here. Gaps are a very powerful trading tool. In our group, I made a video about where I talked about gaps. So I encourage you to watch that video. So I'm not going to spend time here talking about gaps, but 5-minute chart, unless I'm looking at gaps, it's 15 minutes, right? So a green candle means that in the 5 minutes, at the end of the 5 minutes, it closed higher than at the beginning of the 5 minutes. Red is the opposite. It means at the end of the 5 minutes, the price of the stock was lower than 5 minutes ago. So green and red will show you movement. So if we look at that candlestick to the right, the one that's labeled with numbers, right? So the top of the body of the candle just says that at the beginning of the assuming this is 5 minutes, at the beginning of the 5 minutes, we opened up she highlighted it because she knew I was going to say it wrong, and I was about to say it wrong. At the beginning, we opened up at $90, and at the end of the 5 minutes, we closed 5 minutes at $100. During that time, it reached a high of 112, and during that time, it reached a low of 86. So that's what the wicks represent during the time frame, the high and the low. Okay. So this is the anatomy, the basic anatomy of a candle. So now now we know what candles mean. And so now we're going to take it from here to introduce you to really important terms that you will hear a lot. Now, guys, I feel like I need to backtrack. What is the importance of technical analysis? Like, we've already determined reward and risk, and why do I need to know technical analysis? So technical analysis is going to give us our optimal entry points, where we're going to buy the stock, right? We're going to identify where the big investors are buying, where the big money is coming in. And on the flip side, and that's really what's, for me, for my purposes, for minimizing your risk, I care more about your entry points than your exit point. But that's why technical analysis is important, because we're identifying where big money comes in and where big money leaves. So entry point and exit point, where to buy the stock, where to sell the stock. That's the purpose of all of this, okay? Okay, so support and resistance. What does support and resistance mean? The way that I like to think about it is I'm jumping on a trampoline, okay? And when you're jumping on a trampoline, right, you're gonna hit when you hit the floor, like, it's gonna go down a little bit, but it's going to bounce you back up, right? You're never gonna go through the floor. So there's a floor there. That floor is always gonna catch me. So that's how I like to think of support. The floor of the trampoline, that is my support, right? And on the flip side, when I'm jumping on a trampoline, at some point, when I get to a certain level, gravity is going to be pulling me back down. So I'm not going to go higher than a certain point. At some point, gravity is going to take over. So that's my resistance at the top. So that's how I like to remember support and resistance, right? My floor that's keeping me supported, that's keeping me from falling to the center of the earth. And, and I'm not going to like skyrocket. I've got, the resistance that's keeping me back down. So support and resistance, right? When you open up a chart, so these are snapshots from Investopedia, which also is a great resource. This is Investopedia's examples of support and resistance. I mean, these are, perfect textbook examples, but as you can see here, on the chart on the left, this is great support, right? Every time the stock seems to take a turn whenever it hits this level, and we can draw a line and we can determine that this is a line of support. And what you want to do, when you're looking at support and resistance, you always want to look at where the price is now and go back, right? So we start with where it is now, and we go back, right, to determine those levels. And sometimes we have to go like way back. Same thing with resistance. As you can see on the right, there's a price there that, like, every time it hits, it's coming back down. So what does this actually represent? What does this mean? So the support is an area where the amount of buyers, where the buy orders is overcoming, is higher, is more than the sell orders. So when we get to the point where there's more buy orders than sell orders, that creates this reversal, that creates support, right? And on the flip side, resistance, that represents an area where the sell orders, where the profit taking, the sell orders are higher, are greater than the buy orders. So the amount of buyers won, the buyer, like, if you're thinking about it in a tug of war, like, the buyers, they won at the line of resistance, and it's coming down. So that's what it represents, like the buyers and sellers. So, people who are really good at technical analysis, it's actually a very powerful, super powerful tool to be able to identify, like, what these giants are doing. Like, if I know that, where the banks are buying and where the banks are selling, I mean, that's a really powerful skill, right? And I want to buy when they buy, and I want to sell when they sell. Okay. So now what is, thank you. So what we want to do is I want to show you enough to be able to identify areas that, an area of support and an area of resistance, an area where things look like they're bouncing off the top or bouncing off the top. But I want to give you some information to be able to determine whether or not this level, this area, is strong or it's weak. So ideally, we want to find strong areas. We want to find strong support. We want to find strong resistance, right? So this is what I came up with, the condensed version for the time that we have, right? So remember these things when you're looking at a candlestick chart and you're trying to find an area of support and an area of resistance. The longer, the stronger, the wider, the weaker, and risky means run. I tried hard to rhyme and come up with a poem. It did not come out. No poem came out of me. But, you know, but if you can remember, the longer, the stronger, okay, the wider, the weaker, and risky means run. If you can remember 3 things to help you identify whether an area is a strong area or whether an area is a weak area, again, for the purpose of minimizing our risk level, we want to be low risk. We are going to try to find those strong areas, okay? And I think if, you know, and I think if you're not taking a detailed technical analysis course, if you had this, I think this would be good enough for you to enter some trades well, okay? So, and now I'm going to show you an example of what I mean. Oh yeah, by the way, it sounded big. The longer, the stronger, the wider. I'm talking about candlesticks. I'm talking about the candlestick and I'm talking about the chart. And so we're going to show you examples of what it means. So these are all examples of candlesticks, and this is a short green and this is a tall green, and a short red and a tall red, right? And so if you see a long candle, whether it's green or red, both sides, if you see a long candle out, a long candle coming out, or a long red coming out, a long green coming in, this is an indication of a stronger level, okay, of a stronger zone. Why am I saying that? Because the length of the candle, that represents time, okay? That represents, if you see a long candle, then it means that it moved, the price action moved really fast. In that 5 minutes, the price action moved a lot. So why does that mean it's a stronger zone to have this really fast price action? It means it moved, we're concluding, okay, my training, we're concluding that it moved so fast that it left some unfilled orders. It moved too fast to fill those orders. So for example, if we have a long green candle, so when we see a green candle, now we're thinking there's an area of support, okay? And if it moved really fast, it did not give, there was not enough time, there was not enough of a chance to fill all of those orders at that level. What does that mean? It means most likely, chances are it has to come back down to pick up those unfilled orders, okay? So when we see a long green candle, just think it's probably going to come back down. And so if I'm looking for an entry point and I see a long green candle, that's where I'm gonna go. I'm like, it's got to come back to fill those orders. It moved too fast to fill those orders. It's the same thing when you see a long red candle. It sold so fast, it moved so fast that it did not get to fill all of those orders. It left some unfilled orders there. So it's gonna have to come back to that level, most likely, right? In the market, there's no guarantees, right? But we're using this to put the odds in our favor. So the odds are, the chances are, it's got to come back to fill those unfilled orders. Now, let me tell you guys, again, it is really important that when we look at a candlestick chart, for what I'm showing you today, we're also making sure that we're looking at good companies, okay? If what you're looking at is low volume, if there's no volume here, this is not going to apply. There's no volume. It's not going to come back to this level or that level, right? This applies when we're looking at high volume, high market cap, high liquidity, right? So I'm repeating myself again. We're only applying this on the things that we put on our watch list. Okay, otherwise it doesn't apply.
Asma, how far do you look back for support and resistance since 2020 was so crazy? Amy Stevens.
Yeah.
Question.
So how far do I look back? I start with the current price. I want to look at the closest levels to my current price. Okay. So I'm going to start with the current price and I'm going to go back. I'm going to go back until I find an area that looks strong for me, right? So I'm going to keep going. I'm not going to open up a 1-year chart and start, in the middle of that, right? It doesn't make sense because it's already filled all the orders. I'm going to start where it is now and I'm going to go backwards from there. Sometimes I go back like, sometimes I'm going back like a weeks even to find a strong zone. If I don't find a strong zone, and I don't, if I'm not finding a zone, I'm probably gonna move on to something else, something better. But yeah, you always want to start with the current price and you want to move backwards from there. But I mean, open up like a 1-week chart, then can't find a good one, open up a 1-month chart. So now day traders, which this is not a day trading course, but people who are day trading, I mean, they're looking at like the daily movement, but, for the purpose of swing trading, like, look at the whole week, then look at the whole month if you don't find anything strong in the week.
So this is such a good question. So are you waiting on the long green, expecting it to fill or fill unfilled orders and buying on the long red?
So we are buying on the bottom of the long green. Okay, I am buying on the bottom of the long green because I'm thinking, oh, it has to come back down to fill those orders and then come back up. So that's where that's where I want to buy.
Tamara, does that answer your question?
And then on the flip side, I want to sell at the top of a long red, which if you don't have an example of that, don't worry, Yusra. But I hope that answers, so when I see a long,
we're actually going to go through an example at the end, guys.
That's
where
right. We are doing an example.
A live example using a live, real chart. So don't worry, it's all going to come together.
So again, guys, this is probably like the densest, so if it's kind of like feeling mumbly jumbly, like don't feel bad. I struggled with technical analysis and I had to do a lot of practice. But so, the idea is we're predicting, we're getting an idea of where the big money is coming in and out. And these are some guidelines that we can use to find where the big money is coming in and where the big money is leaving. So yeah, I'm buying at the bottom of the long green because I'm assuming there's some unfilled orders there. It's going to come back there. I don't want to buy it where it is now. It's too high because my feeling is it's going to come back down. Okay, so the other guideline is the wider, the weaker. Okay, so what I mean by wider, and this one is probably the hardest one to demonstrate. Is if you have, if you're looking at a chart and there's a time period where it's a lot of candles next to each other. So it's not the individual candle. When I say the wider, weaker, I'm not talking about the individual candle. The individual candle does not change the width, but I'm talking about like an area where there's a whole bunch of candles. It's like a wide zone where all the candles are next to each other. So like in here, in the example that Yusra put up, Yusra, can you circle what I'm talking about with wide zone? It's like, so you have a leg of green. Yes. Okay. And then you went too far, I think. Well, actually, yeah, this whole area is kind of a wide. Okay, so green, and then there's a red, and then I want you to circle after. A wide zone, if there is an area where there's not a lot of like long candles in or up moving the levels, there's a lot of little candlesticks at a similar price point, that weakens the zone. It weakens the level, right? Why? Because the stock spent a lot of time at this price point. So what that's telling us is it's filled all those orders, all the orders that were hanging out there. It gave it a chance to fill, right? You know, everybody got on the bus. So wide zones like that are weak areas, okay? So when I see a wide zone like that, I'm thinking it's probably not going to, I'm not going to set a buy or sell here, because I'm like, all these orders got filled. It spent so much time in this area. It filled all the orders. So again,
we could actually contrast this with the previous chart. So
yeah.
I'm gonna get the previous chart because that one was not a wide chart.
Right. So over here we see those the green candle and the tall green candle and the green candle next to it. That is a narrow area. That's a narrow area. Yeah, like this is considered you know, a level, a buy level, and it's a narrow area, right? It didn't spend a lot of time here versus the chart that Yusra just showed. These are wide areas. So that's a narrow area. Those two green candles next to each other, those are strong zones because not a lot of time was spent there. And when we compare it to a chart that looks like this, these are like a bunch of weak little areas. The orders here got filled, right? So this does not excite me when I see, so longer, stronger, wider, weaker, okay? And the other thing that we are, again, we're using this to determine where we're entering and where we're exiting.
Oh, I forgot I had this example here. This shows a chart that's not wide.
Yeah, and this one over here, you know, I see some good levels here. You know, I see that red candle down, two candles next to each other, long red candle, two next to each other. That's a good, I would probably, if I'm trying to sell, like I would, this would be an area that I would sell. So there's some good zones here. There's some buy, there's some longer candles here. So. And then the other thing that we want to do when it comes to, you know, where we're buying and where we're selling, we're not just looking at the green candle being long, or the red candle and the green candle being long, and we're looking for narrower areas, not wide areas. But the other thing is we want to make sure that that price point still meets the reward to risk ratio, that it's still you know, ideally 3 to 1 up, or maybe 2.5 to 1 up. If the price that I'm looking at, if the price at the bottom of a long green candle does not meet that 3 to 1, I'm gonna move on. I'm gonna find another zone. Okay, so that's what we mean by risky means run. That we're still applying, when we find that price, we're still applying the reward to risk ratio to it to make sure it still meets the reward to risk ratio at that price, okay? So avoiding major losses. So we did I'm gonna stop here actually, and this would be an appropriate place to insert this. So last time when we did the presentation, right? There at the end of that section, at the end of the technical analysis that we just showed, that's where we had most of the questions, and that's where we had most of the confusions, and that's where we had most of the requests for more, okay? And so we realized that, and we felt bad, and so we understood. So what I want to announce to you guys is we are in the works of bringing on, for those that are interested in pursuing this further and building on this, we are in the works of bringing on a technical analysis course, a more detailed technical analysis course, right? And I'm excited to announce this, and we haven't made any formal announcements, but so you guys are hearing it first. This will be a course that Sruthi is going to teach. Sruthi is the instructor who taught the options course. She is a very experienced trader. She's been trading pretty much since she was a kid. She's a very successful trader. And she teaches, she has a lot of students. She teaches technical analysis. She teaches options. And she has like her own like proprietary method that she does. And what's super exciting is that she has agreed to teach, to bring the course to our group, to Stock Market Stories, at a price that's, you know, lower, substantially lower than what she charges her students for, right? And so we're taking a cut from that. So she's not even making a lot of money doing this, but she agreed to do it because she loves the group. She's aligned with the mission. She loves being part of it. So, so we've come to an agreement, and we are going to be putting on a technical analysis course by somebody who's, again, very experienced, very successful, experienced not only with trading, but with teaching. So we are introducing that. It's going to be a 4-hour class. And I think we have a tentative date set. Yusra, Stacy, do we have a tentative date for this?
We do, yes. So June 16, and it's going to be 4 hours. We'll do 2 hours of content, a 1-hour lunch break, and then come back for 2 hours of content.
Yes. So if you're interested in building on your technical analysis, we are introducing a technical
we should be announcing it next week, so just keep an eye out. But I just wanted to say that basic trading, very basic trading, is to understand what support and resistance is. And then there are so many different advanced strategies to technical analysis, and we didn't even get into indicators. When you go into your broker, and there's indicators, a lot of more complicated stuff that people use. So for this, since this is trading 101, we're going over the basics. You know, you have to understand support, you have to understand resistance. That's going to help you set your buy price. That's going to help you set your sell price. But there's so much more to technical analysis. So that's what the technical analysis course is going to be doing. It's going to be delving into the, all the varieties of all sorts of different indicators. It's going to be more specific and more detailed. So don't feel like you can't trade based on the information you're getting in this seminar. If you know support and resistance, yeah, you can get started, and you can definitely trade with just support and resistance.
Absolutely. You guys, again, what I'm showing you today, all the stuff that I'm showing you today, you can absolutely use only that to make profitable trades, right? So again, like technical, I'm just affirming what Yusra just said, right? So what I'm showing you today is enough to be able to apply and make some profitable trades, okay? All right, so we went through, we went through watch lists, we went through determining a reward to risk ratio, we went through identifying a buy level and identifying a sell level, and not only identifying, but also being able to evaluate whether it's strong or whether it's weak. And now what we're going to do is we're going to go into the damage control, okay? So let's just say you've identified a level of support, and you've set your buy, okay? So you picked it up at that level of support, and the stock turns the other way. Something happens, and the market's falling, or your stock is falling. So what do? Again, we're putting all the odds in our favor. We're doing the best that we can to minimize the risk and putting all the odds in the favor. Putting all the odds in our favor. With that said, there is no guarantee. That's the stock market. There is definitely still a chance that you found a strong point and the stock went the other way. What do you do at that point? Okay. So, and this is where I want to tell you guys, we're going to set a stop loss. Okay. Now, I'll be honest, when I was in my training, whatever I had the greatest resistance to, the part that I did not want to accept, was setting a stop loss. Okay. I did not want to set any stop losses. I thought I was better. I was too good to set a stop loss. I'm like, I don't want to take these small losses that could add up. If I'm buying a good company, why do I need to set a stop loss? If it goes down, I just want to wait for it. you know, so I was so resistant on setting a stop loss, you know. And here's the thing, in a bear market and in a bull market, like, okay, whatever. But the danger of not setting stop losses is when we're in correction territory, when we're in a bear market, and you're going to watch your whole portfolio get dragged down, you know, 10, 20, 30%. Whereas if you had set the stop loss and took a loss of like, you know, 0.75% or 1% on each little position, and now you have your money free and your capital free, and you can buy back at the bottom, you know, you would have been better served. So that's why it's important to set a stop loss. And I learned that lesson. Okay, I learned that lesson. Now there are, if you're doing some maybe more advanced stuff, that might be a reason why you don't want to stop loss. For example, if you trade options, which this is not an options course, and options is not a beginner strategy, but if you trade options, that might be one reason why you're not setting a stop loss, because you're going to sell covered calls on your positions. So that's different. Okay, that's a different thing. But if you're not doing that, if we're just following, if you're just following what I'm showing you here, I'm going to ask you to please set a stop loss. Okay. And what a stop loss is it's if the stock goes down a certain level, it's going to like trigger an alarm, and it's going to get you out of that. It's going to get you out of the trade, and you will have taken a small loss. That's not supposed to happen very often. If you're minimizing your risk, that should not happen very often. And I'm going to get back to that. So what would be, where should I set the stop loss? What's a good guideline for a low risk strategy, for a risk minimizing strategy? Where do I want to set your stop loss? And so we're calling this the don't lose your shirt formula. And so a good guideline is like 1% of your capital. Okay. Because 1% of your, the reason why we say 1% of your capital is that you're willing to lose 1% of your capital on a trade. Worst case scenario, if everything went against you, how much am I willing to lose? What would I be okay with losing? So 1% of your capital. I am a little tighter than that, but 1% is good, and it makes the example easy. So let's call that X versus the, so X is going to be 1% of my capital, and Y is going to be the number of shares that I'm currently holding. Okay, so those are the two things you're going to look at when determining where to set your stop loss. 1% of what your capital is, right, or roughly, versus the number of shares that you're holding it. So X over Y, you're going to get a number, and that number is going to be the price per share that you're going to take a loss. So is there an example on the next slide? There is an example on the next slide. Yeah, let's go to the example, and then we'll come back to this slide for me to talk about why this is important to drill it. So let's just say Jane is trading with a $10,000 account. She has 50 shares of stock market stories. Each share costs $20. More than a $20 stock, Yusra. Anyway,
we're just starting out, and of course stock market stories never goes down. Only
okay. So each share is $20, and so where should I, so now here's the thing, Jane already checked off all, you know, she went through the whole checklist with stock market stories, so she's already done that part. She knows it's liquid, she knows the volume is there, she knows the reward to risk ratio is there, she's identified a strong area of support, so she's already done her homework there. Okay, we're not going to skip any of those steps. She's done all of that work, and now she's going to, just in case, she's going to make sure she has damage control that she's incorporating here. So plugging in these numbers, what we get is $2. And so what that means is, it means she's going to set her stop loss at $2 under her buy. So if she put an order to buy at $20, her stop loss is going to be at $18. So if it goes the other way and it hits $18, she's going to get stopped out of it. Okay, so she's going to lose $2 a share But ideally that should not happen often because she's done all the hard work to minimize her risk. But of course that can always happen. With that said, I want to go back to the fire alarm. Okay, guys, this is what I want you to think of a stop loss. If you're like me and you're just really resistant to setting a stop loss, you're like, no, I don't want to take these small losses that are going to add up, right? Let me tell you about, I'm going to tell you how you should think of it. So the stop loss should really be, think of it as a fire alarm in your house, okay? It's supposed to keep you safe. It's the fire alarm in your kitchen. It's supposed to keep you safe, and it is supposed to go off every once in a while, okay? That stop loss, the alarm is going to go off every once in a while, and when it does go off, it should be like a relief. Like, oh, thank God, I forgot that I had the bread in the oven. Thank God it it went off, right? It alerted me. So that's how it should be when you're trading. If your stop loss goes off, it should be like a relief, like, oh, thank God that it took me out of that. Look where it is now. Oh, it saved me. Now, on the flip side, if you're constantly getting stopped out and you're just taking loss after loss after loss, so if your fire alarm in your kitchen goes off like every time you are cooking eggs in the morning, like every time you're cooking eggs, the fire alarm goes off. Well, the truth is there's something wrong with your egg preparation method. Okay. You're doing something wrong with your egg cooking. It's not the fire alarm. Hopefully, if it's a normal operating fire alarm, the problem is your method, what you're doing. You know, what are you letting the oil get too hot? Are you not putting enough butter? Are you not putting enough oil? So on the flip side, it's the same thing with stocks. If you keep getting stopped out, you need to stop, okay, and evaluate what you're doing. You need to, it could be that you are not picking support levels that are strong enough. You think you are, but if you're getting stopped out all the time, you're not. So go to the lower level, okay? Are most of your stocks gray area? Is it a lot of $7, $8 stocks? Is it a lot of gray area stocks? Okay, but that you're not liquid enough. You're not picking a good enough company. So you need to evaluate if your stop loss is causing you to be in the red. It's not supposed to be that way. You need to evaluate what's going on. You need to re-strategize. And I'm gonna tell you, like, if this is a problem for you, please reach out to me, okay? And let's get together and let's figure it out together. Let's figure out why you're constantly getting stopped out. But that's how I want you to think of the stop loss formula. So please set the stop loss again, unless you need those positions for covered calls, or you're putting it into a long-term account. That's different. But for a swing trading, day trading purpose, you want to put a stop loss, okay? So, okay, so now, so you might be thinking like, okay, we went through all of this risk lowering. We've identified the support. We've identified the resistance. Well, where do I buy it? What price do I buy it? And we kind of talked about this already, but again, the price that we're going to set is we're going to try to find those long green candles or those long red candles, right? As a basic. And why we're going to do that is because we're following the big money. We're following the big banks. They're the ones that are moving the markets. So we're looking for strong support, okay? And remember, we're looking for longer candles, hopefully narrow zones. And we're making sure it does not violate our reward to risk ratio. One thing I want to tell you guys is if you determine the price you want to buy it at, okay, and the price of the current stock price is actually the price you want to buy it at, I want you to, even though I want you to never ever use a market order. So when you place an order, there's an option for market order and there's an option for limit order. Limit order means you're physically typing in the price. You're saying, I want to buy Apple at 121 and $0, right? Even though it might be at 121 right this instant, please do not do a market order. Please do the limit order. You guys, this can make a difference between I know it sounds crazy, but trust me, this can make a difference. If you did a market order, it might not fill right away, and that could make a difference between a good price and a bad price, a profitable trade and a not profitable trade, especially if you're using one of those not very sophisticated brokers like Robinhood, right? I mean, I remember like putting an order for like Poshmark on Robinhood, and I did not use limit, I used market. By the time the order actually filled, like I bought it like $7 a share higher than what I was trying to buy it at because I didn't use the limit feature, okay? And so that actually made a huge difference in terms of a profitable trade or a not profitable trade. So again, please use the limit feature. Please don't use the market feature. And that goes not just for buying it, but it also goes for the price that you want to sell it at, okay? Okay, so when it comes to entering, when to enter, we're only going to use like one thing, and that's strong support. We're looking for strong support to enter a trade. We're looking for support. Ideally, we're looking for strong support, and that's for a risk minimizing strategy. Now, when it comes to exit, we have some options here. When should I take my profits? When should I get out? Well, there's three choices. There's three methods that I think are still pretty consistent with minimizing our risk and keeping a low risk strategy. And one of them might resonate for you and make sense. And that's the one you're going to go with. Ignore the other two if you like one of them and don't like the other two. So the first one, the obvious one, is you can set your limit to sell when it reaches a level of strong resistance, right? So the top of the red candles, you can just set it to sell, set a sell order at strong resistance, right? Now, and it might take, time, but you're, maximizing profits, right? So that's one way of doing it, right? Now, a second way of doing it is, again, right now we're in the green and we're collecting profits. So the second way we're doing it is you can just set a target price. You can be like, okay, my goal is to make $100 on a trade. My goal is to make $20 on a trade. My goal is to make 5% on a trade, 3% on a trade. So you can have a target price, okay, and just set it at your target price, and get your money as soon as it reaches that target price. Now, what I is don't put the price that is, when you figure out what your target price is, I recommend that you look at a chart and find the closest area of the closest zone of resistance, even if it's a weak one, to the price that you put, and use that number just because it'll maximize the chance of the order filling and the order filling faster. I think we might have a example of that, so I won't spend a lot of time on that. Okay, exit at your target price or close to it. Now, the third strategy, so again, I'm not saying do all three of these things. I'm really saying ideally do one of these, do the one that you like more, the one that makes more sense. The third one, and this is what I'm doing a lot of these days, is you can do what's called a two-phase method, which is like combining 1 and 2. It's like the best of both worlds. I know, for example, Sruthi, I know she talked about this. She talks about this. I've heard her talk about, selling parts of your position. So the two-phase method means that you are not going to sell everything at one time, right? Let's say I bought 100 shares of Southwest Airlines, okay, and I set a target price. I'm like, when it reaches this target, not resistance, it's my personal goal of how much money to make. When it reaches a 3% return or $100 return, I'm going to sell half of the shares. I'm going to take some profit here, okay? So at that point, no matter which way the stock goes, I'm happy. If it comes back down, if it drops back down, well, I'm going to buy the 50 shares back. I've secured some profit. I'm not sad, that I didn't sell anything. I sold half and I'm going to buy it again. And then if it goes back up, if it keeps going up to a level of resistance, then I will sell the rest of it. So, I didn't make as much money as if I sold all 100 of my shares at strong resistance, but I'm still happy I made money, right? And I minimize my risk. So the two-phase method combines both, is like the best of both worlds. And this is the one that I'm doing more of nowadays. Okay.
But you have to set a stop loss. Don't forget, you have to set a stop loss.
Yeah, you are setting stop loss. Yes.
Yeah.
Okay, so these are examples of like exiting at a resistance. And so if you saw a chart like this, and I don't expect you to be right, but which of these 3 lines would you set your exit? So I'm curious if somebody is bold enough to give an answer.
Okay, so let's do it this way. In the chat, type A, B, or C. Okay, we're just going to take a few minutes. So you entered at this price right here, 87.16. Okay, where are you going to exit? What's the strong support level? Which of these lines makes the most sense? A, B, or C?
You meant resistance.
Yeah, what's the best resistance level out of these 3 based on the chart?
Okay.
Asma, can you see the chat? Do you want to look at some of the answers?
Okay. Yeah, I see it.
So we have a lot of people saying B, a few people saying A, but I think B is the majority answer.
B is the majority. Okay.
What do you think?
What I would think is, I would say definitely not C, because I think it's already beyond the level, right? If we were like charting exactly, we might find that that B is the zone to set the resistance. But if I'm not drawing lines on a chart, I might actually go with A. You know, I just want to make sure that I'm happy with that level. I want to make sure it hits it, even if I missed out on 50 cents a share. You know, I usually, when I find the zone, without drawing charts, I'm going a little, excuse me, I'm going a few cents under. So, you know, between A and B, definitely not C. At C, it's already, you know, it's past the level. Probably not going to fill if you set it at C. So, if you're drawing lines on it, you might find that B is the optimal point. Me personally, if I'm just looking at it, I would probably go a few cents under to make sure it fills, and I would probably go closer to A. Does that make sense? I hope I'm not confusing by being vague about A and B. So I would have chosen A, but I don't think it's incorrect to choose B. I would have been okay with losing a few cents a share and maximizing my chance that the order is going to fill and that the order is going to fill faster. Does that make sense?
Okay, I think we can probably move on because we do have a real life example that we're gonna go through later. Oops, sorry.
These are old samples so the prices doesn't reflect the current price for Southwest.
Right, yeah, we haven't updated these. So so I talked about these, but the one that I really wanted to demonstrate, just because I think it's important. Remember, you guys, for entering, we're going to look at one thing, and that's strong support. But for exiting, we do have some options that are all good and acceptable. One of those options is to set your target price, right? You're going to, and that's going to be personal to you. And so let's just, and I wanted to demonstrate this. Let's just say like Jane, she bought Southwest at this price. The time we did this example, that was the price. And her target is she wants to take home $100 on this trade. So she wants it to move $100 a share, right? So so you would think if you're exiting at your target price, you would just set the order at 32.20, right? So I'm going to tell you no, wrong. don't put an order at exactly 32.20 would be my recommendation. I recommend opening up a candlestick chart, finding where 32.20 is on the chart, and then finding the closest area, the closest zone of resistance, even if it's like a weak zone. So it might not be 32.20, it might be like 32.10. It might not be 32.05. So it might not be exactly $100. Now you might think like, okay, you're just being so nitpicky. Why does this even matter? But the reason why it matters is because that could make a difference between the order filling, like soon, and the order filling like way later, right? You're just increasing your chance of the order filling and of your capital getting freed. So it might not be exactly $100, but you freed up your capital. So that's what I wanted to say about the target price, right? Okay. And yeah, I don't think we need to go through these slides. All right, guys. So we went a little bit over time. So we went.
So let's do this example together, and I think going through it is going to answer a lot of questions.
Absolutely.
And then if you have time, can you quickly just kind of go through sort of like how you prepare for the day?
Yeah, let's do that first. So if you could give us an example of using this method, what are we doing? Are we like, reading news early in the morning? Like, where are we starting from? Where are we ending?
Yeah. Okay. So what does my day look like when I'm planning a trade? So again, the majority of my trades, of my buys, are coming from my watch list, right? So I have a watch list, and I have this watch list. I like to set the order of my watch list by percent change. So it's going from red to green by percent change, and that just makes it so much more efficient. Now I'm spending time usually the night before. I look at my watch list, and I find, a couple of stocks that are meet the 3-to-1. And then I'm going to write them down, and that's what I'm going to look at when the market opens. I'm going to watch the movements. Now, with that said, guys, there's going to be some days where it's going to be hard to find any deals, right? Any trades. And so whatever, I might not trade that day. And then there's going to be days everything looks like it's 3-to-1 up, right? Typically, I'm not a day trader. I'm typically doing a few trades a week. I would say I'm maybe doing like 3 to 5 trades a week. So I like to buy either maybe sometimes in that first 30 minutes of market open, there's like this sell-off that typically happens. So so I already know which stocks I'm looking at, because before the market opened or the night before, I was looking at my watch list and I made a little list for myself. So I might buy at market open, or I might buy so at my work day, I have set my break to coincide with like the last 30 minutes of market close, or sometimes I want to buy at market close. So at market close, I look at, in that last 30 minutes, I'll look at my watch list, and I will see like what turned the most red. And then I will open those up and calculate, reward to risk ratio, make sure it's not on a down annual trend. And I'd like to also buy at market close. Okay. So I'm checking my watch list. Now we have a group where we're sharing things with each other. So if it's a slow day at work, or if I'm not working, I will sometimes get ideas from the group, and then I will, run it through the watch list and things like that. But most of what I'm doing is from my watch list, and I made myself a list the night before, okay? Or I'm checking the last 30 minutes. Does that kind of answer? This is how I do it. And you're going to find that, you're going to kind of figure it out also yourself. You're going to figure out, your own schedule that works for you, the times that work for you. And I typically hold trades from days to weeks.
So I just wanted to clarify something else. This seminar is teaching you a low risk strategy. So I think, Esma, you said like 80% of your trades are this low risk strategy, correct?
Yes.
But sometimes you're taking high risk trades, and that's a different strategy. So if on the group, let's say Esma bought something and doesn't seem to meet this, low risk strategy, you have to understand that some of us are taking riskier trades, and that's okay because the risk associated with it and you've accounted for it. But a good chunk of your portfolio should be low risk strategy.
Especially when we're learning, especially when we're starting out, because that is a sustainable strategy, right? Let me tell you guys, when I follow what I'm showing you now, okay, when I follow what I'm showing you from A to Z, it's rare that I'm losing money. It's rare that I'm taking a loss. Okay, I might not have doubled and tripled my capital by following this method, but it's really rare that I'm taking a loss. I'm not going to say it hasn't happened. I can remember off the top of my head, I followed everything I just showed you guys with FedEx, and I ended up having to cut my losses. Same thing with Best Buy. However, I want to say 90% of the time when I'm doing what I just showed you guys, I'm taking profits and not losses. And with that said, the majority, like on the flip side, 90% of the time where I did take a loss, where I did have to cut my losses on a trade or get out of it, it was risk. It was something that was higher risk. It was a penny stock. It was on a downward trend. It was not volatile. It was, low volatility. So again, I'm reiterating, the majority of the time when I put into practice what I'm just showing you guys, it's really uncommon that I'm taking a loss. Okay. And if you put into practice what I'm showing you and you're finding that you're taking a loss, please reach out to me and let's figure it out together. And it could just be that the entire market is in correction territory, right? So, where everybody's going to be taking losses and then you want to just kind of sit tight. But this is a very low risk strategy. So let's jump into this. I know some of us have to go, and I probably have like 20 to 30 more minutes.
Let's do the example, and then we'll keep the questions on the Facebook group, guys, because we were supposed to wrap up in like 6 minutes. And Esma, I know, has an appointment, so we'll do the example, and then we will go through any questions you have. Just post them on the Facebook, and we'll get back to you.
And we might be able to go to do some questions right now.
We'll see. Okay, so the first.
So let me recap. Yeah, so we're doing an example, but first I want to, because it might feel all over your head right now. Okay, so I'm recapping what we did today. We showed
that's the next slide.
The company, how to put it on a watch list. Okay, and we calculated our reward to risk ratio. We determined support and we entered it. We determined resistance, and we also set a stop loss. We did all of that today. Believe it or not, it might be like, it may have been TMI, and you may have, I'm sure that you're going to want to rewatch this, but we did all of this today. And now I'm going to put it into practice. I have not done this example, so I'm doing it live with you guys. Okay. And by the way, you guys have handouts. So, kudos to, my co-admins for making those handouts. I mean, this is next level stuff for you guys to have these handouts and for you to have this fancy looking presentation, because let me tell you guys, I paid more for some courses. I paid more for some seminars where I didn't have these handouts that I can take with me, that I can practice, where I didn't have a fancy looking presentation. So kudos to you guys for doing that. Okay. So take advantage of those resources that we have.
Yeah, and the last page of your handout is a trading plan outline. So you could just print this last page over and over again and fill in the blanks and develop a trading plan for, stocks as you're researching them. So this slide is just recapping what we're going to do with this stock. We found a stock, that's the ticker. It's called, I think, Invite. So we're just going to go through everything step by step and develop a trading plan for this stock. So first of all, we have to see if we should add this to our watch list. This is a screenshot from Yahoo Finance. Generally though, if you're using your broker, you won't even need to go into Yahoo Finance. All this information, except for the average true range, is going to be on your broker. So we're checking the price. It is over $7. The market cap is 5.5 billion. So it reaches our minimum market cap. So that's good. Our average volume for this stock is 4.5 million. So I went into TradingView and I looked up the average true range for you guys, so we don't have to get out of the presentation and do it again. And it's 2.47. So that means the stock on average will move $2.47 in a day. Then we looked at our 1 year chart. As you can see in the Yahoo Finance, I selected the 1 year chart, and the current price is higher than last year's price. So it's not on a downtrend. Is that correct, Asma?
That's correct. Yeah, it's higher. It's close, but it is on an uptrend.
Okay, and then since I did the 1 year chart and we actually do have information on the 1 year chart,
Good job.
that means that it's this stock has data for more than 3 months. So it's checked off that criteria to be added to our watch list. Okay. So now we have to figure out what the high of the month is and what the low of the month is. This is a really tiny, I tried my best to get you guys the screenshots, but if you're watching on a phone, you definitely can't see this, but you do have access to the presentation slides later, so don't worry. So the high of the month.
You right here, Yusra, to say what we did now is we vetted the stock to make it watch list worthy. Okay, it's worthy of our watch list. So this part is now we're determining reward to risk ratios. This is part 2 of the presentation. Yeah.
So it's on our watch list, and now we're thinking, should we trade it right now? So we have to look at our reward and risk ratio. So our high is $40.24. The low is $25. This is the monthly high and the monthly low. And the current price right now is $28. Okay.
And I'm stopping you again. Now, when I open up a 1 month chart and I see something that looks like this, like right away, I'm like so excited. I'm like, yes, oh, I love this. Okay, so continue.
Okay, so we're gonna plug in all our entries in our ABC formula to make sure it does meet a reward to risk ratio of over 3 to 1. So we put in A is our high of the month, B is the entry price, C is the low of the month, and then A minus B is the reward. So we have $12.48, 28 cents worth of reward, and our B minus C is the amount of risk. So we stand to lose $3 in this trade. And then we do 12.28 divided by 3, and that gives us 409. So our reward is $4.09 to the risk of 1. So our ratio is over 3 to 1. So that means, yes, we can. This might be a good trade to enter.
Absolutely, it's a great one.
Okay. How many shares do we want to buy? For this example, just for simplicity's sake, we set the amount we are willing to lose as $100. You can go back in and do this example again and change that amount. If you're only willing to risk $20 on this, go ahead and change it to 20. If you're okay with risking more, go ahead and come back to this and change it. So we're going to do 100 divided by 3 because that was our risk in the previous formula. If you guys want me to slow down, just say so in the chat. Maybe Stacy can alert me if we want to slow down. So after plugging all that in, we end up with 33 shares. So 33 shares is a good amount to buy if we only want to lose $100 on this trade. Okay, so this is, I put in this slide just, because of the slide, but we're actually going to go into the broker to look at this because we do want to figure out where support is and where resistance is. So give me a second.
We did part 1. the watch list. We did part 2, which is we found a reward to risk ratio and we decided we like it. And now we're going to do part 3. We're going to be like, where am I going to enter? Where am I going to set my buy at? Okay.
All right. So I know this is a little bit hard to see for some of you, especially if you're on mobile. So don't worry, we will get access to the recording, and you can maybe throw it up on the TV or something bigger and fast forward to this part. It'll be easier to see. So what I have right now is my range. This is Webull, by the way.
Okay.
My range right now over here at the bottom, let me get the little thing that you draw with. Pen, that's what it's called. Black pen. Okay. So at the bottom here, you see it says range. So this whole chart is showing me 1 month. Over here where it says interval, this is how much the time frame that the candlesticks are capturing. So since I have it at 1 hour, that means that each individual candlestick is showing me 1 hour of price action. So I think, Esma, you said you like to use the 5 minutes.
5 minutes. When I'm finding an entry point, put it on 5. And obviously, if you do 1 month on the 5 minutes, it's going to be really condensed. So
it's not going to show you the whole month. That's why I just started it with this way. But we're going to change it to 5 minutes, and it's going to show me the most recent. This is the most recent price right here, is the $28. And we're going to try to find a strong support level and a strong resistance level. So
lots of resistance.
Yes, yeah, it seems like it. So I'm going to just go ahead and circle and this is the price it's at now. And then we're going to start moving backwards. So we're looking for a long candle. Is that correct, Esma?
Yeah, so I'm what's going to catch my attention right away is the longer green candle.
These ones right here?
Yes. So,
okay.
So that's a zone. Okay, I see 2 red little candles in between 2 long green candles. Okay, so that's
like this area?
Above it, the middle of what you just circled. It looks like a carrot. You made it look like a carrot.
Oh, I see. My carrot. Okay.
Yeah.
So like this area right here?
Above it, what above? In the middle of the carrot. Yes, yes, yes. This right here, I would probably set a buy. I actually think it's going to come to, yeah, this is a strong zone here.
This is a strong zone for support, yes?
Yeah, this is
right support.
Like, so we didn't go over this, but this is what's called a chair formation, where it looks like a chair. There's like 2 green candles, not on top of each other, but like one of them is removed. It almost looks like a chair. So when I see a chair, usually in the middle where the 2 candles split from each other, sometimes I'll set that as a buy.
Okay, so let me clear the drawings, Esma, and I'm gonna go in to the actual broker and
you know what I did? I took my pen because I was marking what you did, and I marked all over my screen.
The computer screen?
Yeah.
Okay, so is this a good level right here, the 2710?
Yeah, so this is what's called a chair confirmation. Now, here's the thing, though. Now I feel bad showing this because I feel like it may have added, not
confusion.
Having analysis background. You're like, what's a chair? Why is she talking about a chair? We didn't talk about a chair. So I'm going to make it simple. You know what's the first level of support is? Go up on the line. 2750.
Yep.
This level 2750 is a level of support. That is right there is a level of support. Now a stronger level of support is going down to 2640.
Okay, let me just mark 2750
Yeah,
here.
that is a level of support there. So I may set a buy at 2750.
Okay, and
You know, it's over 4. My reward is over 4, right? It's like 4 to something.
yes.
Yeah, so at that price point, my reward to risk might be like 5 something.
Yeah, because we went in under 28 right now. We're under 28.
Yep. Now it is possible when I choose that line, it is possible that it goes down a little bit more, right? But it's still a good buy. Now a strong support.
This is a good level of support using the techniques we've learned in our seminar right now.
Yeah.
Now, if you want to go with like more technical analysis, more detailed technical analysis, that will be, I guess, Sruti's course that's coming up next month, and you can learn about chair formations and all sorts of other good stuff.
And indicators. So I really, the only indicator I talked about today is what's called the average true range for our purposes, because I think you only need that one to get in. You don't need to know all the indicators to make profitable trades. So
okay.
If you are interested in building on, if you feel like you need more technical analysis, there is a technical analysis course in the works. It's going to be a 4-hour if that is something that you wanted to take it to that.
So Asma, let's just go over this quickly. What makes this a strong level of support? Is it because of this long green candle?
The reason why it's a strong level of support is because not the green candle that you circled. It's the green candle that's next to it, the green candle above.
This one?
Yeah, so that is a fast movement up, right? That is a fast movement up. So what that's telling me is it moved fast, and it's a narrow zone. It moved fast that it left some unfilled orders. It did not fill all of those orders. There's some unfilled orders at the bottom of the green candle. It moved too fast. So the chances are it's going to come back to that bottom of the candle to pick up the orders that it left.
Okay, so the bottom of the green candle is a strong support level. Does that make sense to everyone? The bottom of the very long green candle
There's
makes
some
it strong
unfilled
support.
orders.
So I'm just gonna put that, sorry for my writing. I hope that makes sense. I think it was Michaela who was asking about that.
Yeah, I think a lot of people were asking questions.
So
and the chart is really small, so it's hard for everybody to see.
Okay, let me zoom in on the chart.
So Robin asked a good question. I'm seeing the chat now. Why that one and not the bigger one to the left? The bigger one to the left.
So why not this one right here? Why not the bottom of this one?
So basically what we're doing is we're looking at the closest one of our current price, and that's the first one that comes. So it's going to hit there. That's why I chose that one, because it's the first one to our to the
I'm
price.
just going to zoom in so you guys can see the chart a bit better.
Yeah. Now,
so
I actually really like that you asked that question, Robin, because if we look under it, there is a stronger level of support. We do see longer green candles at the bottom of it, right? But the first level of support, is the 2750. That's the first level of support.
So we could say that this one right here is a second level of support, right?
Yeah, that's like the next level of support.
Yeah. Okay. But we want to, because we want to, we're using the most recent strong level of support, right?
Mm-hmm. Yeah.
Okay, so now let's go into resistance. Where do you stop me? I'm going to scroll and tell me when you see a good level of resistance. So someone's asking why not a bigger candle? Is it because of the wick? No, it has nothing to do with the wick. It's just the most recent long green candle. So if you look at the most recent long green candle, this one's also long, but it has a long red one beside it. So all these, the price is pretty much staying in this range throughout this time, right? So that's why this one is the first. I don't know if you guys actually can see my mouse. Let me draw.
I can see it.
Yeah, okay. So this one is the first long green one where you can see that it's struggling with the price here, like that it's not the same price. This goes back to the wider the weaker, right? You have this wide range over here in this area. So that's why we're using this one, because it's the most recent long green candle, this one. It has nothing to do with the wicks. This would also be a level of support, but it's less, sorry, not there, the bottom of that. But this is a further away one. This is less recent, and this one's less recent, and this one's less recent. Does that make sense?
Yeah, so actually the stronger level would be at 2647, where the red then turned into green. It may take a longer while to hit that zone.
So it might actually take a few weeks
yeah.
before it comes back down there.
Yeah.
Why don't you pick a red to use to determine a support and resistance?
So red, we're using it for resistance. We're using the red candle to determine where we're going to sell.
Yeah, so we're going to go through that now. Okay.
Okay. All right. Because somebody had asked that question earlier, and I wanted to make sure.
Okay.
Sophia, I think that was your question. I apologize.
Yeah. So bottom of the green, just remember, bottom of the green is support. Top of the red is resistance. Okay. So we're going to scroll backwards and try to find the most recent level of strong resistance. So Asma, you can stop me if you see anything interesting.
Okay, so hold on, stop. If we are buying, we actually want to go the other way.
Oh, there's nothing. Oh, you want to go here?
So we determined that we are going to.
Oh, right, because we're starting again at our most recent price. This is our start point.
So
and then we work back.
I have decided to set a buy order at 2750, and I'm, picking up whatever 100 shards. And so if I want to use, now again, that's how we're entering. When we're exiting, you don't have to, for the low risk strategy, have to use resistance. You can, if you want to like maximize it, but you can use your target price if you prefer. You can use the selling half of it. But if we're going for resistance, if I want to go from level to level, if I want to maximize it, and I'm a patient person, I'm gonna look for the next red. I'm gonna look at red candles, right? I'm gonna look at where people are making sales, but I'm gonna look at the one that's closest to where I bought it.
So is it this one right here, Esma?
Yeah, that is, yes, I would sell. So where you'll start put an arrow, that looks like a nice, a lot of sell orders did come in here. So it went so fast. So that long candle means that it moved really fast. And because it moved really fast, it probably left some unfilled orders. Most likely it did not get to fill all of the orders. So what that means is it's going to come back to that level to finish filling the order. I don't see that level has been revisited after. So that's
our first level of first level of resistance.
Yeah.
Yes.
So what price is that? 2808.
So I'm going to actually go through my broker and draw a line here. So we said right here at the top of the wick, Asma, or are we doing at the top of the candle?
The body.
The body?
Yeah, the candle.
Okay.
Mm-hmm.
Let me just undo that.
Yeah, I'm looking at, if you want to be really specific, which I think drawing lines, is probably a little more than what we intended to demonstrate today. we basically my whole purpose, and like I said, I understand that technical analysis is it's not possible to be able to put you at a place where you're going to be able to draw lines and chart in the time that we had, you know, but my goal is to be able to give you a sense of identifying levels of support and resistance, and being able to to be able to assess if it's a stronger, if it's a weaker level, right? So don't get hung up on where we're drawing lines and things like that. I mean, I don't necessarily think you need that to make some profitable trades. So
okay, so I have a question for you.
Part is like, you know, over people's heads a little bit.
Yeah, and it's a practice thing. So the longer,
Absolutely.
the more you do this, the easier it becomes. So if I'm buying at 27.50 and my sell is at 28.06, that means I'm making less than $1 of profit on this trade.
Yeah, so this is true. I was looking at that. This is not. So what I would do in that case, I may decide that, hey, it's kind of not worth my time to, this trade is not worth my time. So what I would do, and again, I wasn't really demonstrating this today, but what I would do is I would be like, you know what, I'm going to go ahead and set my buy. I'm going to wait for it. If I decide I still want to buy this, I'm going to go ahead and set my buy to the next level of strong support. And I'm just going to wait. So what we determine that to be is all the way down at 26.47.
So these are all levels of support right here.
Yeah, but I'm going to go all the way down to where it was after the red candle at 26.47.
Yeah, so down here, that's this one. I'm just gonna make this line thicker.
Where it reversed from selling
from
them.
the red candle.
So
Okay.
and now at 26.47, if I put it at 26.47 and then I sold it, I set my sell. If I'm going by resistance, if I'm going by that method, then it's like around $1.50, $1.60 a share. So that's like more worth it for me.
Yeah. So you wouldn't go back to find the next level of resistance? That's not a good thing to do.
I want to look at the closest of where we are today.
Okay.
And then go backwards from there.
Okay. So then there is the potential that my order just would never fill because this is very low.
Yeah, there is a potential that it would never fill, but if it does fill, you're getting a good price.
Mm-hmm.
It's going to be good.
Okay.
Fills, right? And there is a chance that I set 27.50, right? And if it has stronger support below it, that it goes down. That's also a risk when you don't pick strong enough support levels.
Mm-hmm. Yeah. So so we're going to pretend that we're going to do an order. We said what we wanted 33 shares. So as you can see here on the side, it says buy. We're on the buy side. The order type is limit, not market. You don't want to use a market order ever. So we'll go here and we'll do 33 shares. And we set our price that we're going to fill it in is going to be 26.47. All right, so that's how we would fill it. Time in force, I always like to use good to cancel, right? Vesna, do you like that?
Yes.
And then extended hours. So if it dips to this price in the after hours or the pre-market, then you still get it. So you could always select a GTC and yes for extended hours. And this setup's going to look different based on the broker you're using, but they all have like these basic options. Okay, so let's pretend that we're happy with this. And I do have, by the way, guys, I do have a long post on our stock market stories group that talks about different order types. So I'll try to bump that again, or really just if you guys go to the guides, there's a lot of good information about what broker to use, what the different order types are, that kind of stuff. But I'll try to bump some of it up. So now our next step is to set a stop loss. Is that correct?
Yep, you want to set the stop loss.
hold on. I actually didn't. I went to the to my presentation and I didn't share it with you guys. So you're all left behind. Okay. So we found our support and resistance. And now we're going to go next. Where do we set our stop loss? So we're going to pretend that we're okay with losing $100 in this trade. Of course, you can go back and change this number. So our stop loss is going to have to be at 24.97. But that's, I think we had our order at 26.47. Yeah.
Mm-hmm.
So that's $2 and a bit less than what our entry is. Does anyone have any questions on this slide?
That's where you said it, yeah. So we've, again, we've demonstrated this and it's right now it's probably like a lot of numbers and a lot of stuff. And again, I want to encourage you to not get so hung up on the technical analysis part for what we're showing you, because I think like, especially the resistance part, because at that point we're taking profit, the support, the identifying the support is more important right now, but it's going to take a little bit of practice. Okay. Definitely rewatch and hopefully, the important stuff is for what I said today. Like I said, if I had to pick one thing that it was like the most important thing that I'm going to show you today to minimize your risk, it would be to have the ability to assess reward and risk.
Okay, and then
and I
also
hope that you have enough to identify a general area of support to know where we're going to enter the trade. So stop loss, your broker should have a stop loss order that you could set up so that they sell your shares automatically. Again, we'll bump up some posts on the Facebook group, but you guys do feel free to put up a chart on the private trading 101 Facebook group and be like, is this right? Is this a good level of support, good level of resistance? And we'll take a look at it. Okay, so we went through all our steps.
On extended,
sorry, Stacey, go ahead.
Sorry, Yasha. So on extended trading, just remember, guys, like that's trading outside of the normal market. So like the volume and pricing isn't always consistent with what the true market is trading, right? So just be aware of that, because and then also just kind of be aware of like just the trends. Like Asma and I will say, oh, lunchtime sell-off. You'll see that it dips like during the lunchtime when people are like taking their lunches and they're looking at their portfolio and they're like making changes to their portfolios and stuff. And then we also notice like some people wait until like the first 15 minutes after, like 15 to 45 minutes after the market opens to like jump in and buy stuff, because sometimes there's a dip then as well. So, like we want to make this so that it's low trading risk for you guys. So just kind of watch the market a little bit so that you can kind of sort of see like the trends of when that's sort of happening as far as the extended trading hours are concerned.
But I think if you're setting a limit order, sorry, it doesn't matter when it fills. It might end up, if you're setting a limit order at the closest level of support and then setting another limit order at the closest level of resistance.
You're using the formula and you're identifying your support and resistance, then do that. But just kind of be wary about what those pricing looks like before and after hours. That's all.
Yeah, so we're gonna go ahead and buy our shares. I'll change this so that you guys have the updated version of the slides. But we decided that we're not gonna get it at 28. What are we gonna get it at, Asma? Do you remember? 26.47. 26.47. Yeah.
Sounds
so
about right.
I'm just gonna write this down so we don't forget. 26.47, and where we're gonna exit is gonna depend on our strategy. So we could exit if we wanted to do closest level of resistance, that's 2806. Or
so buy 10 shares tomorrow just for the heck of it to see what it does.
okay,
Yeah,
so
actually, thank you for finding this one. So for anyone looking at for deals, this is a good one.
So we can exit either at 2806, or we could do the where, let's say we only want $1 and find a resistance level that's close to that. So do you want to go through that right now, Asma, on Webull?
Do you have time, Esma?
Oh, I actually, I would love to. I do have.
But
Are you guys able to stay on and finish it up?
We'll just do like a couple of minutes.
Okay.
Let's do.
That's why I'm trying to be sensitive of that.
Okay, let's do our second method where let's say I said I want to do $1 profit. So I'm going back to Webull.
Yeah.
$1 profit. And it's, we said we're entering at 26.47. $1 would be 27.47. So that's where we're starting at, is 27.47. What would be our closest level of resistance to here?
So the closest level is actually right about where you are now. You know,
Nice.
there's that red candle there. So there's a little bit of a sell that happened there. It's not a strong level, right? But it is a level. So where you are now, that would be a place where I would put it. There's maybe, you know, even like slightly above, I could even go a couple cents above it. So that would be close to a level of resistance.
So we could do 27.50, let's say.
Yeah, this is just to maximize the chance that it'll fill. So I want to make $1 a share, you know, but I'm not putting exactly at $1. I found that there's a red candle there, which means that there's some sell orders there. So it'll just fill faster. So yeah, just
okay. So let's go back to our slide.
There's an area, maybe a couple cents.
So we'll do 27.50 as our other potential exit area. And our first one was 28.06. And our entry was, no, sorry guys, my writing's very hard. It's very hard to write here. 28.06. And
like,
then,
is that your writing or is that the pen that I wrote all over my screen?
okay, so then our entry we said was 26.47.
Yeah.
So then this is a trading plan.
You've got your plan, guys. That's really all you need to be, it's as simple as that. That's really all you need to be profitable. This is what I do, and this is how I started. So I'm about to have to get off, but I do want to just put some closing words, and then maybe Stacy and Rissa, if you guys can stay on. If you have any questions, y'all, we're accessible, okay? So we have the Facebook group. You can DM. We're going to do a rewatch party. So you probably feel like you need a mental break right now. So I just want to reiterate what we did today from A to Z. That is enough. What we demonstrated today, that is enough for you to take some solid, profitable trades. And I also want to reiterate that when we are starting out, the focus should be to minimize our risk, because that is a sustainable strategy. It is not a sustainable strategy to follow, you know, these groups or these alert services that you're hoping to find the next runner in. Okay, this is a sustainable strategy. You are being empowered to come up with your own method, with your own strategy. And I cannot wait to see what you do with it. I cannot wait to hear what you do with it. And again, if you find yourself in some trouble, please reach out. Let's go over it together. I will sit on the phone with you and try to figure out like what we're doing wrong. Another thing is this, you do need to put this into practice, right? You can receive all the best instruction in the world, right? If you're, you know, training for whatever, the Olympics, or if you're learning to swim, you can receive the best instruction in the world, but you're not going to exercise that muscle if you don't put it into practice. So this is a lot of putting it into practice, and a lot of your broker may have a paper trading account. So if you don't have the funds, if you're not ready to put in your own money, paper trade. Okay, paper trade. Another thing I really want to point out to you guys is I know that sometimes, especially those of us maybe who have smaller portfolios, when I started, I was working with a couple $100s. Please do not become discouraged or obsessed with any dollar amounts. You know, if you're trying to make $10 a day and you're hearing us making $1,000 a day or $500 a day, please do not let that discourage you. One thing that is so wonderful about trading, so wonderful and powerful, is that it's so scalable. If you have the ability to make $10 a day, you also have the ability to make $100 a day. You also have the ability to make $1,000 a day. It is the same skill set that you're using. So please don't get obsessed with the dollar amounts or let that discourage you. Focus on the skill, focus on exercising the muscle and developing that skill. All right, so with that, I have got to sign out. It is my daughter's first dance rehearsal, so I'm going to be a little.
Oh, that's exciting.
Well,
yeah,
so
thank you so much, Esma, for going over the time.
Thank you guys
I really
so
appreciate
much.
it. If you guys want to stay, I'm available to stay a little bit longer. I can take some questions, but Esma does have to go now. So we'll see you around, Esma.
I'll see you guys in the group too. And like I said, I am accessible. I'm happy to guide you through this and to clarify things for you. Okay. And so again, if you had a great time, we would love your testimonials. So we're probably going to put up a testimonial thread. You know, guys, we don't do paid advertising or paid promo or anything like that. You know, we rely on our members, you know, to report their experiences and things like that. So we really do appreciate it if you loved it. If you have feedback, if you have constructive criticism, we appreciate that too. Let us know how we can be better. We are passionate about seeing you guys make money. I get so excited when I'm expecting to see some profitable trades here, and I cannot wait to hear about it. All right, guys.
Okay, awesome. We'll see you around, Esma. Thanks.
Because I'm wearing pajama pants at the bottom.
So. Yeah, go ahead. We'll see you around. Bye. Okay, so I'm just gonna pin myself at the top, I guess, since I'm here. How are you guys feeling? Feel free to unmute yourself or to just tell me in the chat how you're doing. And I'll try to go through some of the questions. We did have a few questions about red days. Okay, so I'm just going to show you guys something real quick, what the purpose of a watch list is. So I'm going to share my Webull over here. So this is, I'm just going to like go into my, this watch list, by the way, is not a low risk watch list. So don't look at these tickers and take them as suggestions. It's just a watch list. But I'm going to show you what I mean. So this is a very long list of stocks on the side. If you see it, a lot of them are green. And then some of them are ideally, I haven't updated this in a while, but ideally you would have some of them are red, some of them are green. So you can go in on any day and be like, oh, okay, this one's red. And then go in and do your formulas for it and see if you should go into this trade. So that's the purpose of the watch list. It's giving you a place to start. It's not a must buy or must sell based on this. It's just giving you a place to start. Does that make sense? Feel free to unmute yourself. You don't see what I'm showing?
Oh yeah, I can see her screen. You Leila, you can't see?
It's just the
I just saw your face. I don't see you sharing anything.
Okay. Oh, okay. So do you want me to just like kind of circle it?
I just see your face.
Oh, okay. You're on mobile, I think. You have to swipe.
On a computer.
On a computer?
Yeah, I saw her presentation, but right now it's your face.
Okay, give me a second. Let me see what's going on.
You have to share your screen.
No, my screen is shared. I
Yeah,
have my
can-
mobile on and I can see it.
I can see your screen from where I'm at.
Oh, I got it.
It's working now?
Yeah.
Okay. So on the side, see, if you find stocks for your watch list, you want to put them in your broker because it's going to give you a live update of the price change. Okay. So you could go in and just be like, okay, this one's red, or after hours, this one's dipping. And then it gives you a place to start and do your calculations and see if you want to get into that trade. Does that make sense? You guys can unmute yourselves. I'm trying to keep up with the chat. I can't see it on my computer because I'm recording the video, so I can't see it on my computer. So I have to like go into my phone to see the chat. But you guys feel free to unmute.
Are these candle charts only on Webull, or every format has this candle chart?
Pretty much every broker will have it with the exception of Robinhood. So,
Fidelity has it as well.
sorry?
Fidelity has it as well.
Yeah, Fidelity
Yeah,
has
Fidelity
it,
has
the
it.
Ameritrade, E-Trade, like every broker has candlestick charts. So I have a very detailed tutorial on how to use Webull on the Facebook group. So if that's your broker, definitely check it out. But basically, it's one of these little things in the top corner where it says chart. You can choose to change it from a line chart to a candlestick chart. So, but every single broker will have this, except for Robinhood. They're the only ones that don't have it. And you can feel free.
I'm sorry if this has been asked before. What chart are you using?
This is a 5-minute. This is a 5-minute chart. See, it says here the interval. It's a 5-minute chart. That means one candlestick is showing me 5 minutes of price action.
And in what company? Like what platform?
Broker. This is Webull.
Webull. Okay, thank you.
But you don't have to use Webull. It's a personal preference. Like I know people in our group trade using all sorts of brokers, and everyone's successful with whatever broker they're using. The only broker that wouldn't show you candlesticks is Robinhood. That's why we don't like generally I don't like recommending Robinhood because of this, is that they don't have the candlestick chart. They won't show you the candlestick chart. But any broker that shows you the candlestick chart, like you could, I guess, technically go into like a different like online platform to get the candlesticks or whatever, but that's just so much of a hassle. It's best to have a broker that has everything. So all the major brokers, I think only Robinhood's the one that doesn't have candlesticks. Everyone else does. So.
And did Asma say you have to go to the 15-minute candlesticks to see gaps?
So 15 minutes is good for gaps. She does have a video on gaps. Let me try to think about which one. I'm going to go through some stocks and see if we can find some gaps here. So I can just show you real quick what a gap is. But she does have a video on this. Okay, so here we go. This one is square. Okay, I'm going to do my little pen. This is a 15-minute candlestick chart. Do you see right over here? There's a section where there's a candle missing. Right here, right? Like it just, the candlesticks are so far apart, right? Do you guys see that?
Mm-hmm.
Like they're not beside each other like everything else.
Yes.
This is called a gap. So what happened is that square here, it gapped up. So it kind of skipped in those 15 minutes and the price moved so quickly that you see a gap on the 15-minute chart. What that means is that eventually it's going to come back down to fill that gap. So it's going to come back down to this level. So if I know that, then I know that maybe I want to wait until it gaps down to this level, or I can set an order at this level. Does that make sense?
Yes. So gapping up means don't buy yet, sell at the buy at the bottom price. And if
it's going to come back down.
Sell if you have it.
Yeah, and then the opposite is true, is if it gaps down, it's going to come back up. So I'm going to try to see if we have some. This one also gapped up. Ooh, it's not good. Let's see. Maybe Neo.
So if it gaps up like that, when do we
Alright.
buy? Or are we supposed to be selling at some?
So if it gapped up like here, it means that it's going to come back down to fill that gap. So gapped up over here, that means it's going to come back down to this price.
We just have
Okay.
no idea when.
You know, you don't know when. So
Right.
sometimes the gap will fill after a day. Sometimes it will take months.
Okay.
When it's a bigger gap, it's nicer. Like it's more of a, like a, I don't know how to say it, like it's stronger or something.
Does it
when-
matter if the two candles at the gap are red or green? Like
No.
these two candles are green, the other one, the bottom one was red, the top was green. That doesn't matter at
No,
all.
it doesn't matter. It just means the price moved way too quickly.
Gotcha.
I'm going to try to find a gap where it gaps down. Yeah, they're all gapping up. I think, I guess because the market just kind of rallied. Okay, so here's the gap down. So this is an example of a gap down over here. Let me get you a
Yeah.
marker. So it gapped down, it was at this price, and very, very quickly it moved down to this price. So you can expect it to come back up to this price, and it did. Like in this case, it came back up to this price the same day. So there is a video on gaps on the Facebook group, and I'll bump that up for you guys. Okay,
And
so
for clarification, that'd be where you'd want to sell it at, that where your stop loss or your sell would be.
yes, exactly, yeah, because I know it's coming back up to this price, so I would sell here, and then I would buy anywhere under this level. This is just if you're just using a gap strategy, obviously. There's other things to look for, like a level of strong support or strong resistance. So this would be a strong level of support based on what Esma was telling you. You get the nice long green candle, so you could set a buy price here. But this is it's easy to see things in hindsight, though. I don't really like doing this on charts where you have all this future history because it's easy to see it in hindsight. But yeah, that's pretty much what you would, that's what gaps are, but I'll bump the video up, and please ask questions on the video as well. And a lot of people have asked questions on the video, and that you can see their answers and you can kind of understand more about gaps. So someone's asking, what are reasonable goals for profit if you want $100 a day starting out or even lower? Profit is going to be highly linked with the amount of capital you're starting with. So it's always useful to think of it in terms of percentages and not dollar amounts. So people say, like, if you're making 5 to 10% profit, that's a good amount of profit. So if you're doing, let's say you're like an amazing trader and you're making 10% profit, if you have $100 capital that you're working with, that's not a lot of dollars, right? But if you're working with $100,000, like if you're 10% of 100 is $10, right? 10% of 100,000 is $1,000, right?
These are the criteria for your to create the watch list, and these are all safe trading methods. You can take your action.
So I think someone's not on mute, and we can all hear you. Just so you know.
Sorry.
It's okay. So just so you know, yeah, so it's not good to think of it in terms of dollar amounts. It's good to think of it in terms of percentage. But so if you're a beginner and you're just starting out, the best thing to do is to start out paper trading, first of all. So trade with fake money, so you can get used to, you know, when to buy, when to sell, how to, you know, track support and resistance, get used to your broker, get used to like everything that comes with trading. And then after you've done paper trading for a while, you can start looking at funding your account, but don't fund it with a lot of money. So maybe start with like $500 or something small. And then if you lose that money, you're not going to be so upset at losing it. And then as you get better and better with trading, start funding your account a little bit more every time you have the extra money. Just fund your account a little bit more. And then slowly over time, you build up your account. Because the skill of trading, like the research you're doing and the amount of work you're doing to buy things when you have $100 amount account, it's the same amount of work you're going to be doing when you have $100,000 account. So maybe now, because I have $100 account, I'll buy one stock, right? But then if I have $100,000 account, I can start buying 100 stocks, right? So it's the same amount of work. They're the same levels of support and resistance. You're just buying more shares. So your profit, the dollar amount of profit that you're getting is more. Does that make sense?
Hi, Isra.
Hi. I'm
Hi.
not sure who's speaking.
Oh, it's Abby.
Hi, Abby.
Hi. I was just wondering if you can tell me, where do I find stocks to update my watch list?
Yeah, that's a good question. So you can, so the way to update your watch list, you can, there's a couple of ways to do it. You can just start thinking, some people, what they do is they start thinking about the regular household names or big stocks that they know. Like I know people literally, they just go look around the room and they're like, oh, okay, that's an Apple laptop. That's a, you know, Microsoft, whatever. This is Nike shoes. And they just kind of go through that. And then you do the research of all that stuff. The other thing you could do is anytime, really the watch list, anytime you see someone's talking about a stock. So if you're on your Facebook groups or whatever, and you see someone's like mentioning this stock or that stock, go through the steps and see if it's watch list worthy. And then the other thing you can do is you have a lot of screeners with your broker. So here I'm using Webull. I'm just going to go to markets, the markets tab. And then you can like look at these ones, you know, to get idea. So Dillard's, let's say this is a name that's familiar to me. So I can like look into that. DoorDash is another familiar name to me. So that's easy to kind of get an idea from these, like all these little tickers that you see. You could also see who the top losers are, which stocks have really been beaten down. A lot of times these will be biotech stocks and penny stocks, so you have to be careful with that. So I'm not even going to look at the one that's like 97 cents, but like maybe the $13 one, I can look and see if it meets my watch list criteria, right? So you do a little bit of work up front, and the idea is you have a bunch of different stocks that then on any given day, you just look at your watch list and see what's red and what's green. Does that make sense?
I'm back for a little bit, and I do mine by sectors as well.
Yeah.
So I break my down into like different sectors, or even like entertainment, travel, and then like I have TD Ameritrade, and so I can build my watch list around like types of sectors. I'm sure they have it in other platforms.
Yeah, they have it in pretty much every broker will have these options where you can sort by sector. And so let's say you're getting into building your watch list and you're like, hey, I'm thinking of Tesla, right? So you go through all the steps to see if Tesla meets your watch list. And then you go, well, what are some other electric vehicle stocks, right? So you go into like NIO and you go into, I don't know, Lee, and you start like going through that list of electric, or then you could even Google search electric vehicle stocks, and then they'll give you a big list, and you can just look at, do they meet the criteria for my watch list? And then have a watch list that's just electric vehicles, because you'll find that if Tesla is down, all the other electric vehicles start going down too, right? These things tend to trade together. They trade in sync. So you could do an electric vehicle watch list, and then you could do a retail watch list, and you could do travel watch list, right? And then you could do another one for food, right? Food and drink, and on, like just kind of like go through it, and then you build a bunch of different watch lists. And then
for swing trading, I diversify. So because a lot of times one sector is up when the other one's down.
Yeah.
And so but I started out like my capital was really not significant. And so like I've grown it to a point where it's the swing account is pretty significant. I think it's like in the $40,000 range now. And I started like pretty low. And so I have a lot of more capital to play with. And so now I diversify it and I do, you know, options and I do other things, but I always try to diversify my sectors because I know that if one is down, most likely well, lately it's all been kind of down, but always one just performs a little bit better than the other. So it just gives you like the ability for you to be able to still make an income like that day if your goal is to make like $75 a day, right? Or
and
$100.
this market generally has been very red recently, but we had like, I remember when before the COVID vaccine came out, things were trading really, really, really in sync with each other. So whenever there was news about COVID cases rising, you would find all the airline stocks are down, all the retail stocks are down, all the stay-at-home stocks, so like Zoom, Amazon, all these kind of stocks that thrived during the pandemic, they're going up, right? So if you already have your watch lists organized by sector or by theme, you know, you can see that one watch list is very red and one watch list is very green. So you want to buy when they're red and then sell when they're green. So if you organize it that way, it's very, very helpful. But I mean, everyone has different strategies to do it, and it's okay. Like there's no one way to organize your watch list or to organize things, and you get ideas from other people too. But the whole idea of the seminar is that the idea however the stock comes to your mind, either because you're looking through different sectors on your broker, or someone called it out on Facebook or whatever, however that stock ended up coming to your attention, you go through those steps to see, is this a low risk stock that I want to put on my watch list, or should I just skip this one? So I hope that makes sense to everyone. Is that okay? Do
you care at all what Yahoo Finance says as far as short-term, mid-term, long-term? Does that coincide with anything? Like if I'm looking at a stock that I like and it has a bearish pattern, would you skip it altogether or would you do the calculation?
So generally you want to keep in mind that everyone has different goals when it comes to trading. So some people are looking at it more long term, and so we're going to go into Yahoo Finance right now, and we'll see what you're referring to. We'll just do this one since it showed up. So this stock, so this is what she was just talking about, is that they have these like analyst reports. It says bearish pattern detected, that analysts think that it might be going down or it might be going up or whatever. I mean, how long are they talking about? They don't usually tell you. Like if you're doing a short-term pattern, that's why it makes sense to start with the most recent level of support and resistance. So watch list, it doesn't matter if the pattern is bearish or bullish, right? Because this is where you're getting your ideas from. Watch list, you just want to make sure that it's meeting the criteria of high liquidity and a good price range and all that stuff we talked about, and the average true range and all that, right? So now it's on your watch list. Should you enter a trade into it? That's when you get into the calculations and trying to find support and resistance. But that's why we start with the most recent level of support and the most recent level of resistance, because maybe generally, the stock, people aren't excited about it long term, but it's making those price fluctuations are happening, and you can trade it, right? Does that make sense?
Yes.
So I guess the step one is, should this be a stock I'm thinking of trading? That's step one, and that's where you build your watch list. And then step two is, right now at this point of time, is it a good trade? And that's when you get into reward and risk and support and resistance and all that kind of stuff. Okay, did anyone have any more questions before we sign off?
Oh, and I'm big on listening to analysts too, like not all the time. Like I don't always listen to the analysts. I always do my own due diligence, and sometimes I just have to trust my gut, because there's been many a times where I've read stuff, and because remember, big banks is the one that moves the money. Like they hold the most cash, right? So they're the ones that typically move the market, and you really have to watch like what the banks are doing, right?
Yeah,
And
I mean, like if an analyst or like Wells Fargo or whatever, they downgrade a stock, that is
yeah,
gonna definitely.
it usually drops, right? Like because they downgraded the stock. But I really read the report to see why they downgraded it, and then compare it to what I read about the company, right? So I don't always, if I see it downgraded and I think it's a really good company, and I think like their article is fluff or their downgrade is fluff, I will buy at the dip, and it usually goes right back up, like
And
3 days.
I mean,
So-
you're gonna find that when Kramer says something, it does move the market. Like that's not like, you know, it's not imaginary. This is what happens when the big analysts talk about something. It will give you a dip or it will give you a bump in the stock, but usually it's very short-lived. So that's why, like, if you're in a position, for example, for long term, unless it's like something like bankruptcy or the company is a scam or something like it, these things shouldn't really matter.
Yeah,
If you're
you
in it
run
for
your
the short term,
calculation, like this class shows you
yeah,
how to
yeah.
run the calculation, then you'll be fine. It's
Yeah.
when these hype stocks
Yeah.
happen.
So if you're in it for the short term, so for me personally, when I see that an analyst has downgraded a stock, that's when it clicks that this could be a buy opportunity, you know? That's when you go in and start doing your research and doing your calculations and saying, should I buy this? Because it usually goes back up. After a few days of their downgrade, it usually comes back up because people realize they're, you know, the traders of the group say, you know, now it's at a discount, I'm going to buy it. And then when you have more of that buying momentum coming in, that actually moves the price up. And so then you can take advantage of that volatility, right? So if someone's upgrading or downgrading a stock, it doesn't necessarily mean that you should buy or sell based on it, but it is a factor to think about. And that's kind of what we talked about when it comes to news. So if, let's say, I don't know if you guys are newer to this, but some of you may remember Nikola, which was an EV company. And they started selling off and their price was going down. And I mean, if you're just using the charts, you'll be like, oh, okay, it's, you know, it's at a discount now, I should buy in. But if you go in and check the news, you would have seen there were some very serious allegations about how much of a fraud the company was. So for me, like when I saw that, I was like, no, I'm not gonna trade this. It seems risky because the news seems pretty serious, right? Sometimes it's very small news, like earnings reports is one of those things where a company actually reports earnings that are pretty good and better than the last quarter, but the stock sells off because people were expecting more from them, or they didn't really talk much about their future projections or whatever reason it is. So the company's not struggling financially, but people still sold their shares. That's when it's like a good opportunity to buy it and wait for it to come back up. I hope that makes sense.
And short sellers are infamous for putting out like news to dip the market or dip a particular stock too. So that's why I said lots of due diligence. Like this isn't without like work, right? So we have to do a due diligence, and we have to have like conviction in the companies and the stocks that we buy. I mean, you can definitely, once you get more experience, you can learn to like trade on the trend, right? But that's after like you know what to do and you know to put in stop losses to protect yourself. And so that's why we don't recommend it for new traders because
And even if you are a seasoned trader, the majority of your portfolio should not be high risk. You should have a good chunk of your portfolio is low risk trades, and then you play around a little bit with the high risk with a smaller portion of your portfolio, right? So that's why it's very
particular ATR number we're looking for, Yasha. Like
above $1. Yeah, above $1,
right?
Yeah, so you want it to be moving at least $1. That was actually in the slide. So at least $1 or 10% of the stock. So if the stock's $8, 10% of that is 80 cents. So if it's moving 80 cents or more, then it's moving over 10% in a day. And that makes it a good trade, or a trade that's worth your time. Okay, I think
Okay, yep, that answered her question.
okay, so last chance, if anyone wants to unmute themselves and ask a question, go for it. Otherwise, we're gonna wrap this up.
I have a question. So if you have stocks in your portfolio already, the long-term portfolio, would you start with those ones as a low risk or no?
Long-term portfolio, you don't touch it. This is a trading strategy. Long-term portfolio, you don't touch those stocks. You leave them. You forget them. You forget about them.
Buy more of the same and try to swing trade similar.
You could, yeah, and there's a lot of people who do that. They have you know, stocks like let's say they hold Apple long-term, but then they also trade it short-term. And that's okay. You could
downgrade the risk. Would you start with those ones, not in the same portfolio?
Oh, you mean because you can just keep it? That's not a good idea.
That's not what you said. Let's say I have Square in my long-term portfolio and I want to open another portfolio where I do swing trading. Would you recommend starting with similar stocks in a swing trading portfolio, or would you start with a totally different watch list?
I mean, you could, but the thing is, you have to have your goals defined before you come into a trade. You need to know, am I short trading this, or am I short-term trading, or is this a long-term hold?
Can I jump in on this, Yasha?
Yeah, go for it.
So I have a long-term account and I have a short-term account. And so my long-term account just basically like sits there and does its thing. I will tell you that on my long-term account, you have to be, as an investor, you need to look at it from time to time and realize if there's a potential dip that you need to sell it, and then you can repurchase it back if it's still a good stock, or you can, you know, sell a portion to get your gain so that you can use the money and then buy additional stocks, right, for your long-term retirement. So that's me on my investor, like in my investment, because I do a lot of reading, and one of the things that is the biggest struggle for people is making a determination whether you're an investor, right, or are you an investor, or are you a swing trader, right, or a day trader? It's really hard because in your mind, like you're always going to conflict, right? Because you're like, oh, should I hold it? Because, you know, my investment strategy is if the longer I hold it, the more money I'm going to make, right? If I hold it long-term, because Warren Buffett tells me that, right? But then there's that other part of me, right, that loves swing trading. And I would tell you, like, up until recently, I'm probably now pretty much even in terms of gains. Like obviously my long-term investment account is always higher because I've had those in there for a longer time and my money has earned more money over time, right? But my swing trade account really does, like, par to par, like make almost the same amount of money because I had to split up my mindset. So I used to trade like some of my swing trade in my long-term account, and it really, like, it did not work for me.
It messes with your head.
Yeah,
it really does.
conflicted with what what my strategies were. So I split them up into two different ones, and then I have money in a swing account, and that's all I do is I swing in that other account. And I use some of the stocks that are in my long-term account to swing. Like, for
Yeah,
example,
that was my question.
Square.
So
Yeah, so
separate
Square,
the
for
strategies.
example, Square, right?
Mhm.
I picked that up at 190. What was it last week when it dipped to 193, right?
197 or something, yeah.
Yeah, I didn't get it down to the 187 piece because I really didn't think it was going to dip down to 187. I picked it
197.
at 193. And I will, once it hit 207, is that right, Yasha? I think at one point on
Yep.
Friday, I think, I sold it. And that was my swing trade. And but my Square, I just left it there in my other, I have it in my long-term account too. And I never touch it. I have it in like the low, like 100s or something.
So I get the question, but I'm just saying, be wary that your intention is not, if I end up entering at a wrong price, I can just keep these long-term. Because if you're going in with that intention or that mind frame, a lot of times you end up making bad decisions when it comes to trading. So it's for sure you should, like, it's most of the companies that are going to be, or almost all of the companies in your long term are going to be solid companies that will meet your watch list requirements. But don't think of it as, if I'm not going to set a stop loss, I'm just going to keep them forever. Because if you end up doing that, then you're going to run out of money really fast.
Yeah, I always
Thank you for answering. That's exactly what I was thinking, that you have to have two different strategies and two different portfolios.
Yes, do it in different accounts because it will help you. I promise you, because I did that at the very beginning, and about trial and error, like I realized that it's not beneficial at all to mix. It just works better for me to split them up.
And long-term accounts work best when you don't look at them. So on red days, when you're trading, you have a little bit of cash, or you're going to sell for a little bit of a loss or whatever. Your long-term, you're never selling them. So you log into your account and you're down thousands of dollars. It affects you emotionally, and it's going to affect your trading. So it's good to just keep them separate. They don't have to be on different brokers.
Or you can
they could be on the same broker.
Buy more, I guess.
Sorry?
Or you consider it sale and buy more if you really believe in the company in the long term.
See, that's what I'm telling you, is that you have to be careful with that mentality, because if you're let's say dedicated $5,000 to trading, and you're thinking, oh, I'm just gonna buy this, and if it dips, I'm just gonna keep it for my long term. What's gonna end up happening is you have no more money to buy.
That's not what I said. If you have it in the long term and it dips, then
you don't sell it. You leave it.
Don't consider it selling it, and if you have extra cash, you buy more. But
exactly.
I average down.
Two separate, and then use the strategies that we learned today in a separate account. You can put $1,000 for now and learn more, but you can start up with the same type of stocks to swing trade because you know them more.
Yeah, for sure. That's okay. Just make sure, like I said, when you're going in, yes, you're keeping it separate.
Yes, that's what I meant to ask, if you would consider that watch list, since you know those stocks more, but have a totally different strategy.
Yes.
Yeah, that's a great idea. And you could also, if you're looking to pick up stocks for long term, you could use the concept of support to figure out when you want to buy it for your long-term portfolio. That's also perfectly fine. So, but just the point is, make sure before you're entering a trade, you know what you plan on doing.
Strategy. Got it.
Yeah, you know what you're doing with this.
Yes.
Yeah.
Got it.
Yeah. And you have to walk away. Like don't think about what you could have gained, because that would drive you nuts too. Like that's the part about investing, right? Because you're waiting for it to accumulate on the gains. So that was hard for me too. Like I would sell, for $2 over what I purchased it for. And I get mad because it went
up another $1
after I sold it. And then so now I don't ever look at it, because to me, like my goal is to make, let's say $200 a day. And if I hit my $200 a day, then I don't have any regrets. And that's the way you sort of have
You
to
feel content. Got it.
no regrets. Yeah.
Yeah. And when you're doing low risk strategy, for sure, you're going to be leaving some money on the table. You have to be okay with that. And you have to accept that. You could wait for a higher price point to sell at, but you're risking it selling off really quickly and you losing all your profit. So that's why low risk strategy, you make less gains than someone who's using high risk strategies, but your gains are more consistent. So that's the idea, is consistent gains again and again and again. You can just keep repeating it over and over again and make consistent gains.
Another quick question. So what if you set up all that stop loss and when you want to sell and it doesn't sell like in a month? Would you look at the your equation again?
Yeah, so the exit, remember Esma said that the exit is flexible. You're not tied down to when to sell. So if you feel like it hasn't hit my price point yet, but I'm okay with the profit I have on it, you can always sell earlier. There's nothing wrong with that. And that's something I do a lot because I don't personally like holding things for longer than 3 days. But I mean, everyone's different. Some people will wait 3 months, 4 months to hit that level. So it depends on your personal technique and your personal preferences.
And if you have money tied up in like a stock, for example, and it's not hitting like your sell level, and you suspect that there's going to be some type of news that will drop the market,
like earnings, let's say, are coming up soon.
Yeah, I sell those without hitting my sell limit. Like I'll sell it so that I can free up money so the next morning I can buy on the dip. So and all of these things you'll know, like I know and it's weird because there's a lot of moving parts actually. But once you do it for a little while, like it will be like second nature for you to like think through that logically to do those things automatically.
For sure. And you'll know what you're more comfortable with and what you like to do. And it's going to be different than what everyone else does, and that's okay. And that's, as long as you have a good entry, your exit is very flexible. So you can choose to exit. Sometimes if the stock's taking too long to reach my sell price, I'm like, oh, okay, whatever. It's like a 10-cent profit, but I'm happy with that. And I don't want to wait anymore. So it's up to you when you want to sell it. Okay, did anyone have any questions about, someone was asking about the good time frame to wait before selling. Again, that's an individual level. Some people like to hold things for only 2-3 days. Some people are fine with holding it for months. So it depends on what you like to do. But obviously, if your closest level of resistance or the resistance level you chose was 3 months ago, then it's probably not going to reach that price anytime soon, right? Versus if you chose a resistance level that happened yesterday, then it's much more likely to hit that price. Does that make sense?
I have another question too, because funds take a little while to clear before you can day trade with them on Ameritrade. I don't know if Webull is different if you're doing short-term trades, which I don't do that much of. I'm planning on opening another account. Is there any benefit to Webull versus Ameritrade as far as how quickly it clears funds? And then if you're selling something within a 24-hour period, are you penalized if you don't have the right kind of account for that?
Okay, so there's 2 different types of accounts you can open regardless of your broker, any broker. You have the margin account or a cash account. Margin account means that the broker is giving you money, they lend you money to trade with, and they charge you an interest rate for borrowing that money. When you have a margin account, you have limits on day trades if your account is less than $25,000. So because you are borrowing money from the broker, they're assuming risk. So they don't let you day trade more than 3 times a week if it's a margin account. So for me personally, I feel like there's no benefit that you get from having a margin account if your account's less than $25,000. If you have a cash account, you have 0 limits on how many times to day trade. You can day trade 400 times a day. It doesn't matter. They don't care. As long as you have the cash for it, it doesn't matter. So that's the first thing, is you have to see if you have a margin account or a cash account. The problem with cash account is the settlement times for the cash. But I mean, it's kind of an option you have to weigh. Do you want to be limited to when you're allowed to buy and sell your shares, or are you okay with waiting for your cash to settle? So what they do is, I know what TD Ameritrade does is that if your cash hasn't settled, they don't give you that buying power. So you bought something for $500 on Monday, and then you sold it for $500. Okay, that $500, you don't get it until Wednesday. It's not going to show up in your account, and you're not going to have the buying power to do anything with it. It's as if it's not there. Webull will give you the buying power, but you're not supposed to sell anything you buy with it. So if I bought something for $500 and I sold it $500 on Monday, Webull will give me that same day access to that $500, and I can buy stocks with it, but I should not be selling those stocks before Wednesday. So, I mean, if you do it too much, they're going to stop giving you those $500 early. So it's really a choice, what you're looking for, what you think is best. I don't think one broker is better than the other. Webull has its advantages and TD Ameritrade has its advantages. So like, I'm not going to recommend one more than the other. And some people are more comfortable with one interface over the other. So,
And also, you have to cancel orders to purchase multiple stocks. That's tying up your cash, right?
If you
have good to cancel orders to purchase stocks at
yes.
your support limit, that's tying up that cash.
Yes.
So I wanted to sit there too long.
Yeah. So a lot of any order you're going to place, any limit order, it's you no longer have access to that cash that's supposed to be used for that limit order. So sometimes if my order hasn't filled in a couple of days, I'll cancel it. I just I don't want to tie up that cash any longer. So it's something you do have to kind of juggle with a cash account, but you're not limited. If all of a sudden, you know, I finished my 3-day trades and I buy something, and all of a sudden the price shoots up and I have way more profit than I intended, I can sell those without being penalized, you know, because I'm not limited to the amount of day trades I have with a cash account. So it's just something, I know Esma really likes margin account, but I personally don't. I prefer the cash account because of this, because then you're not limited in any way. But
thank you.
It's up to you. Yeah, no problem. Alicia, you're asking if everything is down right now, is it a good time to take some entries? I don't know.
I feel like everything has been down, or either the value stocks are all way up. So like the really value stocks don't move a lot to kind of fall in that, the average trading range of above 1. But then everything's kind of down, and they keep saying everything's going to keep going down. So technically our bottom number seems a little maybe not quite be our bottom number.
Okay, so everything kind of rallied on Friday. So I was looking up these examples for the slides, and everything was down for a good 3 weeks, and then it just kind of got better on Friday. So it was really hard to find stocks that actually meet the 3-to-1. But you can, that's when you start with the watch list, okay? And you're gonna have times where your watch list does not have a good buying opportunity yet. But generally when it's red, then it's a good buying opportunity. Some things will surprise you, like Square, I didn't think it would have met a 3-to-1, but it does, you know? So you have to kind of keep looking. But the more diverse your watch list is, and the more kind of different sectors you're representing, the easier it'll be to find opportunities. And you could always look at earnings is a good place to find opportunities, because if someone has just released earnings and the stock gets beat down and it's 2 or 3 days after earnings, usually it starts coming back up. So earnings is a good way to find opportunities to buy stocks. If a stock has been beat down for whatever reason, so airlines, for example, they had during COVID, you know, their price is going down, or retail, their price is going down, but they through no fault of their own. You know, it's not like you think that like they didn't do anything, they're not bankrupt, they're not, you know, like there's just news that's causing it to go down and there's no real reason for it to be down. That would be a good place to start investigating. So there's no automatic buy now, or do you know what I mean? You have to, you're getting ideas and then you're applying the formulas to see if we should buy now. I hope that makes sense.
It does. And since you said like you're typically only holding, let's say 2 to 3 days, are you doing that 3-month time period?
No, if you're doing 2 to 3, if you're 1 month is good.
Mm-hmm.
The only time you would go over 1 month is if you're planning to stay in a trade for like 6 months or more.
Oh, okay. So we want to be on the 1 month.
Yeah, you want to do 1 month, maybe even just 1 or 2 weeks if you want a quick trade. It might be hard to find something that meets 3 to 1 though, if you're only using 1 week.
Right.
So if you have 1 month, that gives you a good range that you'll be able to find stuff that meets the 3 to 1.
Okay. All right.
Yusra, is there a good site to let you know about coming earnings?
Yes. So there's I know Asma posts it every single week. There's earnings. What's it called, Stacey? Earnings Whisperer.
Yes.
They post the earnings all the time. There's also a calendar on your broker for earnings. I'm gonna just show you on Webull because I have that open now. But TD Ameritrade definitely has an earnings calendar as well. So let me see. Where did I go to? I think markets and. Is it screener? I can't remember. Nope. I'm trying to think where I got it from last time. Not settings. I think it was in markets. So they have a bunch of calendars for you. So there we go. Right here, I'm going to try to circle this for you. When you go to the markets tab, you can't find there it is. Okay. So you go to the markets tab, you have a calendar right here. This one's for earnings. This one, and if you click this tab, you get dividends. And if you click this tab, you get stocks that are going to start splitting. And they also have an IPO calendar, but we're trying to avoid IPOs with the low risk strategy. So right here, I can see that this stock rail has earnings coming out 5/17. So it's May 17. BMO means before market open. AMC means after market close. So you can see which stocks have earnings coming up. If you are looking at a stock, so let me just select one of these. Let's say I'm looking at this stock because it's, you know, I'm interested in it or whatever. You can see over here, let me just clear all these drawings. Over here where the ticker is, oops, let me get my pen again. Sorry guys, this is really hard to manage. Okay. So over here where my ticker is, where it says ride, there's a little E beside it. And I know TD Ameritrade for a fact also has this, where you have like a little symbol beside the ticker name, and it's telling you that there's something happening. So if you click on that, then it'll tell you that it has earnings coming out. So I'm going to click on this little E. Now it's telling me that it has earnings coming out soon. So And then it also sometimes shows you on the chart if they already had earnings, there'll be like an E on the day that they had earnings. So your broker will have earnings chart as well, an earnings calendar as well.
Are they showing you that information on your watch list or on your stocks?
I don't have anything on my watch list right now that has earnings. Yeah, but see, I have like a little news thing because there was news that came out on Tesla. So they give me a little news symbol, right? I don't have anything on my watch
But are
list
they
that has earnings.
telling you that because you have Tesla, or
No, it's on my watch list. You
Also,
could
they
have a
should
watch list that's your positions. So you can make all sorts of watch lists for whatever you like. So if I had, so, oh, there we go. So I have this watch list right here. You see ozone, there's a little E beside it because it has earnings coming out.
Okay.
So you can, in your broker, they'll tell you when something has earnings coming out. And then you also have Earnings Whisperer, which posts the upcoming earnings for that week. But they post, I think, the bigger companies or the more hyped up companies. So they don't have all the companies. But it's good practice to go into whatever stock you're thinking of buying and making sure they don't have earnings coming out. So I think also Yahoo Finance should have it. Yeah, I don't, yeah, so it says here earnings date on Yahoo Finance. If you can see it, it says May 18. So even if you just look at the ticker on Yahoo Finance, it'll tell you that it has earnings released soon, coming out soon on May 18.
So you have to click on the stock that you're looking at and then go to the information.
Yes, if you just want to make sure that they don't have earnings coming out before you buy in, just search it up really quickly in Yahoo Finance or check it out through your broker or whatever, just to make sure that they don't have earnings coming out soon.
And I'm sorry, how do you spell Weibo?
It's WEBULL, but I highly recommend you use a referral link if you're going to open up an account, because then they give you free stocks. So no, there's a lot of referral links on our groups. So I'll bump up that thread for you, and you can use someone's referral link and get some free stocks. Okay, I think you're welcome. So I think that's it for now. I do want to tell you guys, you should definitely look at the guides we have on the stock market stories group, because there's a lot of information there that's completely free, and it's very useful, and you don't have to. So I'm going to stop sharing for a second. I'll show you guys what I mean. Hold on. So if you go to our Facebook group, we have a whole section that's called the guides, and they have so many different subjects that you can see, different topics that we discuss, a lot of different resources. So let me just go ahead and share it if I can find it. For some reason. Okay, let's try this again. I'll share my Facebook screen. There we go. Okay, so if you go to our Facebook group where it says guides right here, you just go into that, and we have so many different resources for you. And there's videos. You'll find the gap video in this section right here, and you'll find the Webull. This is a whole Webull tutorial. I think it was like 2 hours long. And you have like, what can you do when the market is down? You have all sorts of resources for you in the guide section, and you don't have to go through them in order. Just like scroll through and see which topic is interesting to you. And so this is the which broker should I use. This one, everyone has all sorts of reviews about all the brokers that they use, what they like about them, what they don't like about them. You'll find referral links here. There's the different kinds of orders. We go through all of those in this post. So there's a lot of information here on a lot of things that you can. We have a lot of taxes resources as well. So just make sure you're looking at the guides because they're very, very helpful. And we'll see you in the Trading 101 group. Okay, I think that's it. Thank you so much, guys, and have a great day. And I hope you all have a great rest of your Sunday, and we'll see you around on the Trading 101 group.
Thank you.
Thanks, Giselle.
Okay, bye.